All right. Hello, everybody. Welcome back to another episode of the Market Close. I'm here today with Mr. Tanner and Mr. Neil. How are you guys doing?
Doing well, brother. It's crazy time in the market since you've been sick. I don't know what you do to these markets. You keep the whole market stable, and then there's chaos whenever you're gone. So hopefully there'll be some stability now that you get better.
We really tried to bounce, and it's not really working. It's not working. We got Oracle earnings in about 15 minutes. We'll talk about that, but let's just get into some of your thoughts about the market. Neil, this is lower than yesterday's lowest levels. I mean, what are your thoughts on why we're feeling the sell-off right here?
I mean, if people have speculated, we might have speculated a little bit as well, right? Maybe it's SpaceX. People are raising cash to buy a $2 trillion overpriced company on Friday. I don't know. Maybe that's the case. Or maybe it is a CPI report that was in line, but still tells us that inflation is creeping up higher. Next week, first FOMC meeting with Kevin Warsh. So you mix all of that together, plus the Iran thing, you get a, I guess, shaky market that has been going up significantly since the end of March. So it's not like we are back to prices from 2023 or so. We're basically back to where we were, what, a week, 2 weeks ago, something like that.
Yeah, it does feel pretty aggressive. 760 to 726 is not as crazy of a move, given how quick we went up from 726 to 760. But the fact that we're looking at a 7.2 handle, it's a bit sobering, I think. 1.4% down. We were down about 1/3% yesterday, although we did go down 1.5, then recovered. And then obviously Friday we were down, I think about 1.5 as well. Tanner, any thoughts on why you think we're experiencing this sell-off here?
I think that there's been a couple different things that have been spooking people. So I don't know, like good news means bad right now. We ended up seeing a hot jobs report. This might have been calling for another reason for rate hikes, hot CPI. But then we saw the Crusoe news that came out yesterday where they might have a large customer that's canceling a build out of one of their data centers. So maybe the AI build out is coming to an end, and we're looking towards cost reduction. It turns out the story's kind of developing right now. Maybe Crusoe wasn't being entirely truthful and they got kicked off the project. I'm not entirely sure what's happening. But I think there's a lot of jitters, a lot of fears whenever stocks run up so fast, so quickly. And that's what's been happening with a lot of AI infrastructure names, like semis and hardware has just skyrocketed recently. So, once one domino falls, I think a lot of people get very jittery and they sort of wonder like, okay, I've made a lot of money. Now let me try to secure this. And then it kind of creates a domino effect of people trying to be the first one out the door.
Yeah, I agree. I think the semis trade is not over, but man, it has gone so vertical that some level of consolidation is not the craziest thing in the world. Micron still is holding $900.
Yeah.
In the face of this drawdown. I mean, AMD, which was at 200 in the lows of the March drawdown, it's at 453. So it's like, obviously NVIDIA is the one that hasn't really done the best, but at its core, a lot of these names are still up a ton. And I think that goes to show how resilient a lot of the semi names are, or rather than how resilient, how much they've moved, so that even, a 20% drawdown on most of them is still not leading to too much pain. Before we get into Oracle, a couple of macro things. Trump was live and he said a couple things, some of them a little confusing, others, I guess people can interpret it, but here's what he said about the inflation print.
Sir, Mr. President, about the latest inflation number which came out this morning. Could that be a
No, I love it. The numbers were great. You know what I really love? I love the inflation. You know why? Because as soon as this war is over, I can say it now. Something you didn't know. We've been taking out millions of barrels of oil. Nobody knows it. You know who doesn't know about it? Iran until right now. We took out the other night 22 ships late at night with no lights.
Sir, Mr. President.
So apparently Trump is saying he's fine with inflation because he knows that oil is going to come down and eventually inflation won't be that big of a deal. And then he, I think, dropped a relatively big piece of news. Today, I am pleased to announce that this effort of executing a secret mission to support oil tankers and other commercial ships to the Strait of Hormuz resulted in more than 100 million barrels of oil making its way through the strait and into the open market. I had no idea there was this secret mission going on. I think I didn't hear any headlines
You
about
had
it.
no idea. Friggin' Chris Wright tweeted about it.
Chris Wright? Oh, Secretary. Okay. He did today?
Yeah, you remember they said they now brought through a couple of tankers. This was a while ago, and then he deleted the tweet like 30 minutes later.
But then this was not a mission that happened last night, as Trump is saying. Then this was a mission from a month ago.
Yeah, it's not just last night that Trump is tweeting, or at least that's not what
You're right. He said last month. You're right.
Yeah, he's saying just like over time they've been able to get through 100 million barrels.
I mean,
So I
to
think-
his
Go ahead, Neil.
no, to his point, oil is under $100.
Right.
Like people were saying oil is going to 130, 40, $50 or so. For now, it's still under $100, hovering around that $90 mark or so, which again is still high. But yes, once we do have a deal or this story ends one way or the other, prices are going to come down naturally, just like they are coming down every time there is a tweet that lasts for 2 seconds and then the exact opposite gets tweeted out again and it's up 4%. So it is true that this is what is driving the oil prices right now, and it can be resolved in a month or two. The
Yeah,
rest, probably not.
And to this point of the comment, maybe that's what's been keeping oil under 100. Maybe this secret mission that has resulted in all this excess supply, because it is kind of surprising why the heck is oil not breaking through 100 for the past couple of weeks, especially with all
Yeah.
these bad headlines. Maybe this is part of the reason. So, yeah, it seems like the inflation print today was interpreted badly, which is why the markets are down. I think more so the markets are exhausted with the semi-trade to an extent more than inflation. But Trump is kind of thinking like a regular retail investor, which is that if inflation is bad now, if the war is over, inflation will be better, and theoretically it will be a dip that is worth buying. Jose, we got Oracle in 7 minutes. Thank you for joining us. What do you think happens with Mr. Oracle? Wrong mic.
Yo, Mike, microphone.
This guy just came back from vacation. He's probably
No
He's
way. Did he
half
again?
retired.
Pretty sure he
half
came back from
retired,
vacation.
and-
No.
I'm pretty sure he came back from vacation.
I was at a bachelor trip for my brother-in-law for a while, but what? I mean, I don't know what to think about Oracle. I mean, demand for compute is crazy, right? I mean, it is crazy. We just saw Claude release Fable or whatever it's called, a Mythos sub, and people are burning out of tokens in like less than 2 hours. I was trying to create something, and then it started charging me because I had my overcharge go, and I'm like, all right, maybe we can wait until my things reset so we can continue. But I mean, that showcases the crazy amount of demand that we are in a token shortage. So I think it's long-term bullish for companies like Oracle, because if like Anthropic is releasing something like this, OpenAI is going to release something like this. Then we also had Supermicro, right? Just announced that they're raising funds because they got 38 billion new orders in the last few weeks. At post earnings, AI servers is going crazy, and I'm going to guess some of those orders are probably coming from Oracle here.
Yeah.
So I'm expecting a nice growth in RPO. If there's one thing I'm expecting a nice growth in RPO.
600 billion, you think?
To be honest, Neil, I'm not sure where we're at right now. Are we in like 520? We're
Yeah,
Five,
yeah. Should be around that range.
maybe 550, no? Something like that.
either high 580s, I think, is where if we're in the 520s, at least high 580s is what we should see. But I think demand for compute is still crazy.
Dude, the projects that are coming out from Fable 5 are insane. Like single prompt, full video games. I don't know if you guys have been following any of those. The Minecraft clone one is a pretty cool example. These were designed with single prompts, and then the model essentially ran for 4 hours.
How many tokens did they burn?
Probably a ton, but it's still a matter of, okay, is that cheaper or more expensive to pay a human to do a similar job?
Is it a real game, or is it, because I mean, I've seen a lot of previews and one prompt games, etc., but it's not really a game that you and I would play.
Yes, I get that, but a lot of the, like, you can use that same similar, okay, help me solve this real project that's actually working on, you know, something for our accounting team or something like this, that is, you know, there's been a lot of major companies where their code is going directly into their actual apps. Look at Google. I think they announced like something like 60% of code or whatever was being written by AI. It might even be higher now.
Yeah, I think someone here, maybe not me, but someone here should have like, hey, let me give AI a $50,000 balance. Can you create a full game with this? Because I'm pretty sure creating a full game is a lot more than $50,000. So to see it, right? So it's like probably for these things that we're seeing right now, people are spending maybe a few $100s at most. But again, not me. Maybe one of you guys can try this out and let me know how it ends up working.
He's nice with his not me. Maybe one of you guys just came back from a cruise trip and the Bahamas trip and whatever, semi-retired with all of his chips investment, and now we have to burn money on tokens.
Yeah, he just wants us to make sure we burn money on tokens so the chip stocks keep pumping.
Yeah, exactly. Funds his next vacation. He's got vacations stacked on vacations.
Let us know in the chat if you think Oracle's going to pump or dump. I have 56% dump versus pump. I don't know about this one. I think Oracle should be fine for all the reasons you guys have talked about. Compute constraints, data centers. They are levered up on OpenAI, which is, I don't know if there's a little bit of sentiment shift on OpenAI right now, and that's led to a little bit of fears around some of the companies that are associated with it, like SoftBank and Oracle. The neoclouds, I think this is a regular drawdown. I mean, 211 on Nebius sucks when it was at 290 a couple weeks ago, but it also got to 290 really quickly. So, you know, it's kind of going the same way down. Oracle was at 250 the other week. It was at 130 in the April lows. I think if we hold 180 to 200, I'm pretty happy about that. I don't think it has to be so dramatic to go down to 150. I don't think it has to be crazy to go up to 250 again. So I don't know. This one's going to be a hit or miss. I think the implied move is about 8%. And they're going to have to say something really dramatic, I think, for it to go up or down in a pretty aggressive way.
One thing that I did see, I don't know if it was today or yesterday, that OpenAI is supposedly planning a new 10 kilowatt data center with NVIDIA.
Gigawatt.
But I 10 gigawatt. Yes. What did I say? They say kilowatt. Man, we can buy that now. Yeah, 10 gigawatt data center. But I don't think they announced what the cloud service provider would be. And
I think it's built in-house.
You think it's built in-house?
Yeah, that's what the article says.
Oh wow!
Yeah, they don't want a provider. They're working with NVIDIA directly. Here, I can find the
paywall. Big money there.
It's not well. No, I've got the. I got past the paywall with the dollars.
Let me close up the markets. Then we will keep.
Yeah, go ahead.
Discussing Oracle. Here we go, folks. It is pretty ugly day across the market. S&P looks like it's going to go down 1.5% Wednesday, June 10th, as the markets are now closed. $725.49. We are down 1.5% today, officially from the highs of 2025. We are down 4.6%. Call it 5%, which is a pullback. Technically, 10% is a correction. So we are officially experiencing a pullback, and obviously that's led to about 20 to 30% drawdowns in individual names. Nebius right there, 211. Robinhood, incredibly resilient today. Like, you would think this thing would be red. It's not red on the day. Still up 3%. It did get to 91, closed at 86, but still up 3% in a sea of red. And I think maybe there's some insider buying and agentic tailwinds that's leading to that. Google, down on the day, 356, very close to Berkshire's private placement price. Tesla, 381. Palantir, 130. ServiceNow, 106. That was down about 1%. CoreWeave, 95, down 3%. Amazon, down about 2.5%. They lost 240 on Mr. Amazon. Microsoft probably closed below 400. Microsoft indeed did close below 400, 397. Nvidia, I don't think we went below 200 today. Never mind, we did. 199.92, closed at 200.42. So ugly day for Nvidia, but this one kind of close to where it was yesterday. And then Bloom Energy right there, 9.7%. SMCI down 20%. So a lot of these names in the semi trade obviously got hit pretty hard. SMCI down almost 30%. AMD down 5%. But regardless, this is the nature of this market. CPI was bad, and now we kind of got to see how much the market can digest from everything that's going on.
I'm just going through the report from the information right now. There was a couple parts. They didn't name, the only companies that they named in this was SoftBank, NVIDIA, which they're going to look to finance this deal. I don't know if you saw that as well. First of its kind for NVIDIA, and then OpenAI. And they talk about in this report that OpenAI shelved its near-term plans to build its own data centers. However, this potential deal with SB Energy would bring it much closer to having more control over its own cloud capacity and potentially lower its compute costs. They also say that, yeah, they repeated again, having more control over its own compute capacity would in the long run be less expensive. However, it's still a costly endeavor. They never talk about a CSP.
Yeah, so I mean, I think the bullish thing on that is you're having more data centers. The bears will say it's more circular financing because NVIDIA is backstopping the data center. But at the end of the day, at least you have more data center production, which is, you know, what the AI trade needs.
Here's the interesting thing about OpenAI paying for this data center while you look for Oracle numbers. If Blue Owl or, you know, Masayoshi Son or Oracle or any of these companies pay for these data centers, they might have to pay for a 10 gigawatt data center like anywhere between $500 billion and $1 trillion. For NVIDIA to pay for this data center, it would be like 1/4 that cost because they have to pay for their cost of goods. They don't pay the NVIDIA premium on their own chips. Because there's a 75% gross margin on the most expensive cost of the data center, which is the chips and networking.
But NVIDIA's not paying for the chips. OpenAI is still paying for the chips.
Yes,
right?
but they're fronting it.
Okay.
They're fronting it, and then from what it looks like, there might be a potential. This is all rumors, right? Two people who know or who are in these discussions, whoever is leaking this information to the information. That's what they're saying, is that NVIDIA is looking to finance this deal.
All right. We're going to see what happens with these corresponding data center deals. Oracle should be out any second, guys. I think 4:05, so in about a minute.
I mean, didn't Jensen talk a lot about the fact that he thinks OpenAI is going to become a cloud player in the future? Like, I'm pretty sure he said it a couple of times. Jose, you seem like you want to say something.
It's funny because he kind of backpedaled on that a little bit. At one point, he did say that, and then he was like, "You know what? Maybe they're not really gonna go to direct route of building their own data centers anymore." But I mean, with this market, it changes every other month. But last I heard, it was kind of him like backpedaling. I was like, "Hi, no, they're not gonna build their own data center. They're actually gonna go and purchase from partners." If they are gonna build their own, I think it's crazy because I mean, 10 gigawatts is a lot. A lot of players can't even get that much power, so they're most likely leasing from a lot of these other power companies out there because that's a lot of power if they're just kind of starting that push right now.
It's 4.5 times the energy requirement than the Hoover Dam that it generates.
All right, Oracle, 2% move, now 2% red. Wow. That one does not know where it wants to go. Now 3% red. That was a quick 212 to 196 move. I don't have the numbers yet, but that
apparently it's out.
Okay, I got it. Oh boy. Software revenue missed. Street wanted 6.88 billion. They came in at 6.82. Software licensing revenue missed. Street wanted 1.93 billion. They came in at 1.88 billion. Overall revenue barely beat. Street wanted 19.1. They came in at 19.18. And then EPS, a more healthier beat. 197 Street wanted. They came in at 211. So they missed on two of the software metrics. They beat on top line revenue barely. They beat on EPS. The data center headlines I don't have yet. Stocks down 7. 189 now. Let's see if it can fight back. Oracle in fiscal year 2027 expects to raise approximately, oh shit, 40 billion through a combination of debt and equity financing.
Don't they have like
Is this an
100
extra 40?
That's why the stock's down. If I'm just reading the headline, but if that's a new 40 billion, if that's an additional 40 billion versus what they've already committed to, they do not expect any additional debt in calendar year 2026. Yeah, that has to be a new 40 billion. That's probably why the street's upset.
And they're what are they at now? $155 billion in debt or something like this?
Roundabout, yes.
So they're going to $200 billion.
Dude, if Google can do 400 billion, little Oracle can do.
Yeah, but Google is backed by billions in free cash flow, while Oracle has 0.
Oracle has 60 minutes. Where they
I don't
can
know how
talk about
Nvidia
data
falls on this news. This is like, you got
centers.
companies.
Oh
literally going,
my, you're right. Nvidia's down.
I don't.
I'm out of here.
I don't get
Peace
that.
out. Yeah, this is crazy. They're raising an extra $40 billion. That is wild.
I hope that 40 billion is something they've already mentioned. And that's
No,
not-
it is not, because they said in fiscal year 2026, which is the one they just finished, they raised 43 billion. Then they're saying in fiscal year 2027, they expect to raise an extra 40 billion.
oh my gosh.
Nvidia sells a drug that's so powerful that companies are literally going bankrupt to try to get more of it. Like, and people are selling off the drug dealer as well here. I don't get
Wait,
it.
but then it's saying it does include the previously announced 20 billion at the market equity issuance. So maybe it's only 20 billion extra.
Maybe it's only 20, but still 20 billion.
Still,
I mean,
yeah, crazy.
Oracle's credit default swaps were up 230% this end of 2025 into May of 2026. So if you put on more debt or lever up in any bigger way, the credit markets are going to be annoyed, right?
Yeah, we're not just. It's not just 20 billion. It's 40. Like, the dilution is still a massive hit to shareholders and raising more money to buy more chips.
Yeah, I think this is an additional amount. I'm reading an article from February 2026 where they announced 50 billion in debt and equity. This has to be a decent amount that's newer than, even if it's only 20 or 30 billion. Oracle right there down 6%.
We didn't talk about their RPO, did we? I don't know. I don't want to be that Neo. But it raised to 638 billion, up 85 billion from a quarter ago.
That's good, right?
I would think so.
638 billion. That's good.
Up 85 sequentially and up 363% year over year.
Yeah, that's almost 100 billion in 90 days.
And they said most of the RPO increases in both quarter 3 and quarter 4 were large-scale AI contracts where the customer prepaid Oracle for the purchase of the GPUs, or their customers bought and supplied the GPUs to Oracle.
I mean, outside of the equity raise, this is not a horrible print, right? I mean, I'm still trying to get the rest of the numbers, but
I guess the market wanted to see them recognize revenue from that backlog maybe faster or something. I don't know. Because if you're looking to raise even more money, then why is it? Is it because you see an acceleration and you want to capture all that acceleration, or you're not seeing the acceleration and you need more money?
That's a fair point. So they missed on 2 of the software metrics. They're raising an additional 20 to 30 billion. RPO is up a lot with prepayments, which is good. EPS is a decent beat. I guess the revenue acceleration, to your point, Neil, is not that aggressive, which means they're not recognizing enough of the RPO yet. I mean, RPO technically it's not real, right? It's like it's theoretically real, but it's not real until it becomes revenue. So if that's not hitting the top line yet, maybe that's what the street is upset about. But I really think it's this. Oracle expects to raise approximately 40 billion through a combination of debt and equity financing. That right there has to be the sentence that the street's upset about.
Wait, what's that CapEx number? 90 billion?
That is wild.
crap.
Holy smokes.
The estimate
is
that might
wow.
be our actual reason, folks. The estimate was 69 billion. They came in at 90. Nvidia shouldn't be down. If that should be so good for Nvidia.
Like, dude, I feel like a crazy person looking at this. Like,
True.
it's just story every day. It's story after story. It's like companies just like, please let me get more. And it's like they're raising all this amount of money. They're going into debt. They're bankrupting themselves to get access to Nvidia chips, and Nvidia falls.
Yeah, I mean, like, it's crazy, Tanner. We just had freaking who was it? Google made that deal with SpaceX. I don't think I've been here for a while that we talked about that. But
Yeah.
$1 billion a month to buy GPUs. Like, I thought TPUs were taking over, but then they're spending almost $1 billion a month on GPUs if it goes online fully.
Nvidia GB200s to be exact. Let's be
But, yeah. But,
That
screw
deal-
Nvidia.
That deal is a little bit pumpy though for the IPO, if we're being honest.
100%.
I don't think so at all.
Tanner, they can cancel the deal by December. And
Okay,
why
what about
would Google
Anthropic?
pay 300% more for a rental price under GB?
What about
Same for-
Anthropic? Why would Anthropic pump SpaceX?
No, Elon himself said Anthropic is a very short-term deal.
Yes, so is the Google deal. I think that they're both short term. They can
pump the
cancel
IPO.
anytime they want, but why are they paying this market rate today?
Because Google has a big stake in SpaceX, and
Why is Anthropic paying this rate today?
Anthropic definitely needs the compute. I'm not saying they don't need the compute. I'm just saying there's no way in hell these guys are going to pay 3x the average rental price for the next couple years. Like, that's not sustainable.
No, but I think that we're so compute constrained. Google, in their last earnings, said we would have grown faster than 63% if we had the GPUs. They have the customers ready.
Yeah, but if they're paying 3x the rental price, they would make no profit on any of that growth. At
Well,
some point, like,
I think that they would make less profit. I don't think they would make no profit, but yeah.
Axios, Trump holds Situation Room meeting on Iran strike. Trump is considering large-scale military strikes against Iran following negotiation stalemates. U.S. officials are wearing a decisive operation to force Iranian concessions in deal talks. That also doesn't help. That doesn't help when you get an Oracle print like this.
Why does Oracle pay a dividend at this point? I
They pay a
don't get it.
dividend? I get a
Yeah.
dividend from Oracle? What?
Yep. 50 cents per share.
Yeah, they could take that shit. I don't need that.
Six estimate revenue topping expectations at about $19.2 billion, and its remaining performance obligation, which is the clearest signal of demand yet, jumping by $85 billion to $638 billion. The street was looking for $595. So a clear indication that demand continues to ramp. But here's the news on the new debt and equity offering for fiscal year 2027. Oracle now expects to raise $40 billion through a combination of debt and equity financing, including its previously announced $20 billion at the market equity issuance. Now, this comes after the company raised about $43 billion in debt financing and about $5 billion in equity. That was what was announced in the prior quarter, but this is what the street was sort of concerned about going into this report, Melissa and Mike, the idea that the company will have to continue to ramp up more capital issuances, specifically on equity and debt, in order to meet the promise to build out all the data centers it has across the United States. We're watching shares down about 4.6%. We will want more details on the call from Chair Larry Ellison, the co-CEOs, about how they will defend this new plan and how analysts respond.
For sure. Yeah, obviously it's
I don't know, guys. This one it's fighting after hours. Maybe Larry Ellison can get it to pump, but
What are the Neo clouds doing? Probably
that's a
all
good
down.
question. Nebius flat to down. CoreWeave down about 1%.
Yeah, Oracle's strategy, I find, is very similar to Oracle and CoreWeave, taking on tons of debt, signing with the biggest names in the market. Nebius is very different, I find, than these two. They're getting huge prepayments, dealing with small customers. Well, I mean, they have a lot of bare metal deals as well, but they have a lot of small customers as well. So CoreWeave should be down.
Tanner, are you impressed by the RPO number? Because I still think that's 630 billion is kind of crazy.
Yeah, It's wild how big Oracle's is comparatively to the other big tech names. Now, I don't have any Oracle. It's like the only name out of all the companies that we cover that I don't have. But I'm not sure. What percentage of that is OpenAI directly and only OpenAI?
Honestly, I'm not sure. I think, well, it's at least 300 billion, so probably around 50% of it.
Yeah, like it's a huge percent.
But they did say that the prepaid portion of their large AI contracts total $75 billion. So they are getting some nice amounts of money to buy some GPUs.
Yeah, this
Okay.
is weird. I agree with Tanner. This idea that this is not bullish for Nvidia. Now, maybe the whole AI trade is taking a breather, so Nvidia has to take a breather. But
What is prepaid revenue backlog? Is that not? That's just revenue. What?
no, but do they recognize it?
No, it's probably not. It's probably deferred. But I guess that's RPO, but that's not revenue backlog.
Yeah. Oracle says we have not yet initiated the at-the-market equity portion of the financing program, which is $20 billion. In February, we announced our intent to raise up to $50 billion in debt, along with the statement that we do not expect to issue any additional bonds beyond this amount in calendar year 2026. Within days of the announcement, Oracle raised $30 billion through a combination of investment-grade bonds and mandatory convertible preferred stock with a record order book that was substantially oversubscribed. We have not yet initiated the at-the-market equity portion, which means I think that 40 billion is net new, because they're saying they already raised 30 billion in February, which is calendar year 26. If we're in calendar year 27 now for them, they have 20 billion of debt, 20 billion of equity, so it should be a brand new 40 billion.
Are you guys? Do both of you guys have Oracle shares?
Yeah.
No, I do not.
Look, I bought it in April because Nebius and CoreWeave were going crazy. And I was like, well, Oracle's theoretically the ultimate neocloud with the most amount of backlog, so they should catch a bid, which they did, from 130 to 150, now at 200. But I mean, the debt they're taking on, again, if we hate Oracle's debt, we have to hate CoreWeave's debt. If we hate Oracle's ATM, we have to hate Nebius's ATM. Like, all these companies are ultimately doing the same thing. They're buying GPUs and building data centers with other people's money. So I don't know, maybe the 7% reaction was a bit extreme, which is why it's only down 2%, but it's barely holding that 2% drawdown.
Yeah. It's just a matter of if you think OpenAI and Anthropic are going to continue to grow. And it doesn't mean that the models just get smarter. It means that customers actually show up and are paying. If that continues to happen at higher and higher rates, Oracle's going to make their money. The neoclouds will make their money. The semi chips will be sold. But if you guys find that you're not paying for tokens, that you're kind of going, like, you've played with the tools and you're kind of going back to just doing what you did before, who knows? The craze might slow down, and that's where the bubbles will be created. But I don't know if I see those signs just yet. But yet the market, it feels like they are feeling those types of feelings, like not bringing up, getting worried about CapEx increases. But these types of CapEx increases, to me, like an earnings season that is fueled by CapEx, means that these companies are expecting to grow. I find this much healthier than, Apple going up year after year just by buying back shares. Like, I'd rather an earnings growth increase, not just my ownership going up.
Do you think the market is just having enough with the amount of CapEx that's being spent, and they just want to take a break before they keep giving a premium to all this debt and equity issued CapEx, even from the hyperscalers like Google? Or it's just a silly reason for the market to be upset? If the market wants growth, and this is the way you get growth.
Yeah. I think, like, whenever these companies like Broadcom accelerates growth, and I think the amount of semiconductor solutions revenue they had went up like 78%. And people are like, wow, that's a lot, but is it sustainable? whenever something goes up 20 to 30%, you can hire for that. You might be able to sustain this growth. But I think that there might be a lot of people that just simply think that, a lot of this build out is not sustainable. I obviously disagree with that, but I think it's too much too soon, and it freaks investors out.
And then you have all of the headlines about token budgets and things like that popping up. So it doesn't add that much positivity, because eventually you would like the cost of tokens to go down significantly instead of going up every single time. I think I'm trying to find, there is Chris Patel shared a nice chart about token expenditure. Let's see.
For those that are just joining, Oracle revenue up 21% year over year, EPS up 24%, cloud revenue 9.9 billion, that's up 47%. SaaS revenue up 10% year over year, 4.1 billion. RPO is up 363% year over year, $638 billion. And their fiscal year guide is for 29%, which is an acceleration in Q1. But they will also be issuing some debt and equity to be able to continue their growth. Yeah, I think the stock probably stays down a couple of percentage points or goes up a couple of percentage, but I don't think it has a dramatic 9-10% move up or down, unless Larry Ellison says something on the call. But this was a good quarter. It's just the debt that I think the street's fed up with, but none of the numbers look bad at all.
Can you pull up the tweet, the post?
What do you think the market needs to see? Like, what do you think all the big tech CEOs, all the conversations that they're having, that they're seeing that the market isn't?
See or hear? Here,
Yeah,
probably. Again, with Oracle, I think, like you said, I think it's the same as with CoreWeave. It's okay, we hear you, we hear all of the positive things, but show us. Like for CoreWeave, it is show us that margins are bottoming out next quarter. With Oracle, it is show us you can monetize that huge backlog and you see your way out of your huge debt problems. I guess that's what the market wants to see.
Yeah, and I think the market doesn't want to see this on the screen, right, Neil? I think your point here is that if the open source model or Chinese models become significant magnitudes of token usage cheaper than what the current LLMs offer, then a Uber might go to a DeepSeek, and that would be bad for Anthropic's growth, which would be bad for Oracle, OpenAI, etc.
But it would be good for something like a Nebius, because they've been talking about the fact that they don't want to see consolidation across the globe. They would like to have multiple models and where people come to their token factory, etc., and they figured it out themselves. It makes sense. Like you cannot have token usage go up significantly, prices go up significantly, yet your output, the result of it, is not that much better than before. And so, yes, you are going to see people flock towards open source model, Chinese models, or whatever. So they will have to figure it out, which I think they will. I think you will figure it out eventually. Right now, we are maybe at the tipping point, and then things start to spiral down.
Yeah, that would be my biggest risk for Anthropic and OpenAI. I mean, because at the end of the day, like if it is cheaper to run massive amount of workloads on models that are just as good. Now, obviously, they're not just as good yet, but if they get distilled to the point where they're going to be just as good, that whole Jevons paradox thing needs to really kick in for Anthropic and OpenAI to have a moat. Because right now, I mean, what is the moat of those companies? Model lock-in? Because that can be changed very quickly if a new model comes out and it's cheaper and slightly better.
Yeah, I think the word moat might be a little strong for those companies right now, but they have advantages, right? They just have really good models. Yeah, I don't know if there is an Anthropic or OpenAI moat. I think people kind of try all the different models.
Do we think that is a legit bear case where if the gap keeps getting narrower between the foundation premier models that are worth trillions of dollars and a DeepSeek, which is worth like 30, 40 billion? I mean, obviously, there's a lot of American companies that probably won't use a Chinese model. But the point is, if cost does come down dramatically, could that justify the necessity of not paying as much as people are paying for Anthropic or OpenAI, even if token usage goes up exponentially as well?
I think it's a matter of like the type of tasks that you're doing. I think the Fable 5s and whatever the non-neutered version of Mythos is going to be used for, you're not using those to write emails and draft tweets and think of different, like for us, the average person, the regular open source models, the Gemini Flashes of the world is going to be everything you need for a personalized assistant. The extreme frontier models are going to be for specific use cases. For the Andre Karpathys of the world, he's going to be using the top of the line models because, you know, the problems that he's trying to solve are a lot more difficult than the problems that I'm trying to solve. So I think it's the lens that you look through that depends whether or not the frontier models will continue to expand.
I think that's a fair point. Here's Brent Thill on the Oracle quarter.
Brett, in terms of where this announcement of the new capital raise intentions, you know, kind of sits relative to street expectations and your expectations, how do you read it?
I think everyone is bracing for a raise, given what's happened with Google's raise, the potential for Meta. Microsoft CEO said, don't rule out another raise. I mean, you look at the investments that are going into CapEx for the AI movement, everyone's going to need to raise more money, whether it's through debt or equity. You can't just keep raising in debt. And so we think equity is going to be another way that these companies go to market. And Oracle, you know, upsided their CapEx plan by $5 billion. So they spent more than expected. So I think you're going to continue to see another huge year of CapEx build out. That's bullish if you own semis and infrastructure at this point. So yeah, I think you're going to continue to see this across large cap tech, and the race is still on to find enough powered shell capacity to put all this equipment in for the AI movement.
RPA was better than expected, Brett. I'm wondering if Brent if there's any color on whether or not that additional, you know, upside was from additional customers, if there's any sort of diversification of its customer base at this point.
Yeah, Street's looking for 35 billion sequential increase in RPO. So that's remaining performance obligations, their backlog, key leading indicator of health. They came in at 85, so about 50 billion better on the RPO. And that, again, I think is an indication of their clients spending on AI infrastructure. The disappointing factor we didn't see is the application business. There was an application deceleration. So, you know, Oracle has the infrastructure business, which benefits from AI, but their apps business could potentially have a short-term impact as companies stall and build potentially new apps on Anthropic or OpenAI or extend their Oracle apps. And so that's the slowest growth in apps we've seen in 6 quarters. So that was not good overall, but overall solid print. Stock had obviously gone from $140 to $200 a share since April. So we've had a really sharp improvement in terms of the stock performance, given the fear of OpenAI and the tie to that story. And I think the health of OpenAI is more healthy than most think. And that's reflected now with the stock at 200 plus.
You know, we were talking earlier about, you know, you've now signed up for this reality where, you know, Oracle's CapEx is going to have to run ahead of revenue coming in, and kind of their customers are using Oracle's balance sheet to get this stuff built out. That's how all these companies are doing it. I mean, is the street going to be happy to place, you know, a healthy and premium multiple on that type of dynamic longer term?
I think short term, Oracle's in the same boat as Microsoft, Amazon, Google. They're all spending massive amounts of money in infrastructure, and the ROI is starting to trickle in, but we won't see it for another year or 2 years. So we're in this kind of awkward, I call it the teenage zit phase of not knowing exactly what it's going to look like. And we think over time, if they do this right, they can have a big monetization on the bottom line. Data has gravity. If this AI data and you and I have multiple agents and it's creating more data, then Oracle theoretically is in a really good spot to manage and control those agents and the data. But we're not really going to know this for another year to 2 years. So in the interim, the reason why software is massively underperforming and semis and hardware is outperforming is that if all 5 of these big companies are spending all this capital, why even take a risk if it's going to pay off? You know it's paying off in semis and hardware and energy and data center builds. And so I think the safe choice, again, is where most of our investors have been. Software's down 10% year to date. Semis are up 60% plus. And I think that continues given what we're seeing in future equity raises. When you see that the magnitude, the CapEx spend, these names that we cover in software are going to continue to underperform as we see this ROI come in. And again, it's going to be a couple of years before we really truly understand the magnitude of the ROI. We believe in it. We think there's signs of it, but the real investment upside still is not in our group, and it's outside the software. It's inside the other picks and shovels that are getting bought to build all this AI infrastructure.
Your colleagues should buy you dinner, Brent. I mean, you're a software analyst trying to sell other sectors. I wanted to ask specifically about the software business for Oracle. I mean, it is the biggest component of the IGB. So what is the read through, looking, since we've had a few rocky days on software, on tech in general, but software in particular, what is the read through from Oracle's earnings specifically?
The SaaS business wasn't good, Melissa. I mean, it was the worst quarter in 6 quarters. So again, I think that investors are more focused on the infrastructure business and less excited about the SaaS business here. But I think the read-through is in the interim, there's no real catalyst. 70% of software industry is decelerating this year. And that's a signal AI isn't here and all the investments are going somewhere else and they're not ready for AI. And so I think that, again, it's okay to, I cover this group, but I don't have to defend it. Investments are happening outside. It's not a great read-through for the rest of the software industry. And I think it's more of the same. Things are okay. They're not as bad as everyone thinks. And, Thoma Bravo declared the SaaS apocalypse over in the last week. I still think we're going to be living in a tough time for the next several quarters as we transition to new business models, new pricing. Can they show real AI breakout play? And we really haven't seen it. It's a lot of talk, just not a lot of action. You just don't see it in the numbers. So we're waiting. We're patient. But right now, again, all the fun's happening in semis and hardware, and you can stay outside of my group for the interim.
Brent, thank you.
Oracle sits in an interesting spot where it is software and semis in terms of data centers. I didn't know this was the worst quarter in six years for software, but that's not encouraging, I would say.
Yeah, but like you said, is it really the focus?
No.
Probably not. Probably not. But I mean, I don't know, when you look at the numbers, they beat. Cloud missed a little bit apparently, but margins are fine, which is already encouraging. So again, I think the market is just, again, not believing the whole story. The market usually also has issues when we talk about huge numbers. Like I gave this example today. When Apple reached $1 trillion in market cap, people are freaking out, like how much higher can this go? And then it reached 2 trillion, then 3 trillion. And then we have 5 companies in $1 trillion market cap. Like big numbers are scary at first. And then we're just like, okay, it's the new normal. It's the same here with this all AI build outs, like big numbers, super scary. But eventually these companies, I guess they know what they're doing. Or we think they like to light hundreds of billions of dollars on fire, which I don't think they do. Tanner is laughing about something.
No, I'm letting you guys talk about Oracle. I don't know. I don't know Oracle's business, like the actual software side or anything like this, nearly as much as you guys. But the comments are really funny, and yeah, I'm here more to talk about the data center side and the chip side and the overall build out and these sort of things. Oracle's just a little too not diversified, but I just find their business harder to understand than some of the straight up neo cloud plays, and then a little bit more confusing than the big tech plays. Like I've just never felt the need to buy Oracle versus, let's say, a Google and Amazon, or like a Nebius, for example.
For those asking about Jose, he had to leave, so that's why he left a bit early.
Yeah.
Okay, so Tanner, CoreWeave. Is this, in your opinion, one of the more undervalued neo clouds here? And do you like this over Oracle at these levels?
Well, they're very similar to Oracle in terms of the amount of debt that they're taking on, and they're raising and just taking on like a ton of risk. They see the opportunity and they're going full force. So this is going to be a company that 10x's or dies. Like, and you need to be aware of the amount of risk that they're taking on. That said, they are a pure play. So the revenue growth on the data center side is growing at the rate that the actual company is growing at. So that's like 113 or 112% year over year, and they're expected to accelerate to 190%. Their backlog is growing really quickly and is at the size that Google was last year. This brand new company, super small, has the amount of backlog that Google had 1 year ago. So I don't know. I think it's an interesting name, but I'm not full porting it. It's just it's a spec play on the data center space.
Neil, your thoughts on the NeoClouds, CoreWeave, Nebius, Cypher? Are you thinking of some of the more speculative, smaller names are bets right now?
I'm okay with my Nebius. I might actually increase the CoreWeave a little bit if it continues to drop closer to $90 or something. CoreWeave for the points that Tanner has said, and then Nebius because I do think it's the best positioned AI cloud hyperscaler in the making. So I'll stick with those two. I don't need extra exposure, especially since I do own Google and I love a lot of Meta, although I know Meta doesn't have a cloud business, but I do think that eventually they will open up a little bit and they'll generate billions of dollars through that. But yeah, those Nebius and CoreWeave for me is good enough. I know a lot of people are probably asking in the chat about IREN. I guess if they can find the money and they can find the GPUs and put it all online, then the dollars will start flowing in. But you need to build a data center and plug everything in, and then you'll see dollars flow.
Yeah, I think it's interesting. If the compute constraints are as serious as they are, as Jensen says that they are, then, as much as it's annoying that these companies are diluting with equity and all this stuff, at the end of the day, it's not going to matter because there's going to be such explosive growth long term, which is, I think, why we've seen the valuations of a Nebius and a CoreWeave make the move that they have. And even Oracle, I know it's barely up this year, but from the lows, it has been better than not. Over the past 5 years, it's up 142%, which is part of the reason they probably feel okay with diluting as much as they're doing. They were at 350 in September 2025. I think I was with Tanner at the Robinhood event that day they put out that quarter, and the next morning it pumped to 350, and that's when the street was like really sipping the Kool-Aid, and then it kind of came back to reality what they're going to need to do to get that type of growth and how much of that growth was because of OpenAI. But at this point, I think the street has to come to the conclusion of either we're going to own the names that are going to be using the debt markets and the equity markets to be able to raise capital in order to continue this massive growth revolution around AI that we keep hearing is amazing, or we're just going to stay on the sidelines and not believe in it. And I think more often than not, the street wants to take a chance on these companies.
It seems like the street is going to take a huge chance on a $2 trillion company on Friday at a ridiculous valuation and selling Google and Amazon and Meta and Nvidia and whatever today, which to me makes zero sense. I don't know. Is anyone buying SpaceX here on Friday?
I think a lot of people, not myself, but I think there's going to be a lot of demand.
Oh, demand for sure. It's probably going to pop and maybe even surpass $2 trillion, but...
Mm-hmm.
I'm not buying that shit. I can't. If I get some shares at 135 assigned to me, great, because it'll probably pump, but I don't know how to justify or underwrite that investment. And I've tried to hear a lot of smart people give their take, and it just sounds like they're bullshitting. Like even when they try to explain how they can make sense of 2 trillion, in reality, if they know anything about business valuation, it's tough, dude. Even at a 1 trillion, you could definitely justify it. 1.3, you could justify it. At 2, 2.2, 1.8, it's tough. when everything else is sold off as aggressively as it has. NVIDIA, Meta, Amazon, etc. Now, hype can justify it, which is what I think the whole roadshow over the past couple of weeks has been. But I don't know if hype's enough if we actually get a real drawdown.
Yeah, I do find it interesting that like the high majority of the opportunity that they're talking about for SpaceX is just purely in AI, unrelated to space. And how that's not being translated to many of the other, they might make chips, but the chip makers are not getting a large premium. And they're potentially can get into data centers and charge 3x the market rates, but the actual data center companies are not, running on this. I find the valuation extremely hard to swallow. And the only reason why they can charge 3x the market rates is because XAI was a major letdown for them, and they expected more than what they actually put up. So if any company canceled their AI plans and sold compute to the market right now, could get a 3x market rate. So I'm just, it's just hard for me to try to understand the valuation here, even though I do want SpaceX. Like, I think that would be such an amazing company, especially after the merger. But you're merging like two of the most expensive $1 trillion+ companies together. It's like, let's create one big hopium stock in one.
Well, that's literally what it is. You just cannot make sense of it. And it's not even like, oh, you're being a spreadsheet warrior looking at the numbers. It's like, forget the spreadsheet. This is nothing. We're past the spreadsheet when we come to the valuation. Now you're just trying to be somewhat even remotely reasonable, even with expectations that are super ambitious. And you can't get there. You have sell side analysts going to 2040 and assuming 80% EBITDA growth every year to be able to make the assumption make sense. It's not there.
Yeah,
So
not even to justify the current valuation. You want the company to grow. Like, you're buying the company to hopefully to, go up 30%, 50%. Like, you have to justify that valuation.
Right.
How do you do that?
And if it matches the S&P 500 returns, then why the hell did you take the risk of buying SpaceX? So it has to beat the S&P over the coming years. It should be doing it aggressively, but at $2 trillion, it's tough. So I wonder, if it does end up having a successful IPO, at what point does it take a hit? Or is the market going to allow it to sustain a $2-3 trillion valuation for the next few years with no problems? Which, if we're being realistic, they didn't let Tesla sustain that. Tesla had to come down 50-60% many times before it even got back to these levels. So I think it might take more time.
You would think that Grok is the top 3 model in the world right now, and that's why they're getting a huge premium. But fact of the matter is nobody really uses Grok, and that's why Anthropic and Google are getting all of those allocations at Colossus 1 and 2. So, yeah.
Yeah, that's the one thing that's been impressive. The rate at which they've set up some of these data centers is mind-blowing. And they definitely do have an advantage. There's something unique about their team that allows them to set up, potentially gigawatt.
They don't follow the rules.
They do not follow the rules. And if you compound that out across every single thing that company is doing, they probably deserve a premium. But premium doesn't mean justify every single valuation. Like, 2, 3, 4 trillion. There would be the same people that are justifying the $2 trillion valuation would justify a $3 trillion valuation with the same financials. They don't care what the valuation is. They're just saying it's justified because of the TAM. And the TAM is what we could put anything. Like, AI taps in every market. So you can just write down the amount of money that the United States government has today. Boom. We'll do everything.
Those are the numbers for Oracle. If you're just joining, the call should be in about 15 minutes. We got a pretty big headline right here. Pete Hegseth, we will be striking Iran tonight, and we will be strong and clear. CENTCOM will be busy tonight. We will be striking Iran hard. We will bomb key facilities in Iran. The strikes that will happen tonight will be strong and clear. Iran had a chance to make a great deal. They haven't been willing to do it. They're going to have to tap bombs dropping on key facilities in Iran from the U.S. It is not a restart to the war, but to set the terms for a deal. Yeah, I don't know if the markets are going to love that. Why are they announcing it like that too, right? Like
It's like very strategic, I have to say. but then again, looking at the series of tweets and posts over the past 2 weeks, is like even when you're the enemy, you don't even know what the heck's going on. It's like 1 p.m. I would like to have lunch with Moshtaba, and then 2 p.m. They are going to be obliterated, and you're like, okay, what the heck's going on here? We don't know.
I was thinking back, like if you were to go in past wars, like the Cold War even, or World War II, like what are some of these tweets looking like from these people? They're talking to each other through social media tweets and commentary. We get to see it all in real time. And I'm just like, man, it's ridiculous.
Here's what Hexa had to say.
And so those strikes that'll happen tonight will be strong. They will be clear. If they happen to happen tomorrow night, they will be strong and they will be clear. And throughout, Iran has an opportunity to make a deal. That's the point. President Trump is a deal maker, the best in the world.
This is... Oh, man.
You know what happens tomorrow? Mexico plays against South Africa. First game of the World Cup. In your countries.
Is it happening in New York? Where is it happening?
The opening game now is happening in Mexico.
Oh.
Obviously.
Wait, the World Cup is starting? That's so soon that the World Cup is starting.
I'm so happy Amit doesn't know like me. I'm not the only one.
Dude, I know nothing about the World Cup. Like literally nothing. I didn't even know it was starting tomorrow.
Yeah, because you're busy with the team that's on your head right now, no? Aren't they playing tonight or tomorrow tonight?
Dude, if the Knicks lose tonight and this market keeps crashing, like, and I have COVID, like this week just sucked, bro. It was just a bad week. Like it was like not a good week.
It's only up from here, my friends. Only up from here.
This is pretty incredible, though, dude. They've been telling us a deal is coming every week for the past 3 months. They've been wrong about it. Even the times where you got close to thinking they would be right about it, there was nothing there. Like every time you got the Axios headline that says it's ready, it's like, no, there's nothing. There's absolutely nothing there. I mean, if they can't get to basic agreements on opening the strait, getting nuclear uranium enrichment done, opening up some sanctions, and getting this over with, it's incredible that we have just not been able to resolve this.
Yeah, I do really worry that this is just going to keep dragging on. I assume that most wars started with a couple weeks worth of conflict as being the initial like plan, and then it blooming into multi-year conflicts. And that's my only concern, is that this truly does not find an end for years. And there's just constant fighting and tension with Iran.
I feel like it won't be years, but it might still be months. And I don't know, dude. I don't know how 2026 plays out. I mean, it is a midterm year. There's so many different variables against 2026 being good historically that we've defied all those odds. But 3 bad sessions and we've lost a month and a half's work of progress in 3 days. It just shows you how quickly the markets can evaporate the gains and how quickly people, because it's hard for people to buy on the way up. It's really easy for people to sell on the way down because no one wants to lose money.
Yeah.
And I feel like, that might be happening here.
Yep. But eventually you will have to make the decision, or whether or not you would like to discuss with new partners, or say, you know what, we're done for now. We'll revisit this in a couple of years' time. Because, I mean, you cannot start this type of conflict without either going all the way to the end, or, I mean, having some kind of result. Because now this limbo situation does not make any sense. Like either go all the way in or just like shut the fuck up and be done with it.
Is that a bad word?
Dude, the way but Neil, I wish I could say STFU the way you say it.
Yeah, there's a lot of
there's passion.
yeah, passion behind
Shut
it.
the fuck up. There's so much passion in it. What is on people's watch list? So if you had to pick, I'll do 3 stocks at these prices. Look on your watch list right now. Look at the quotes on the tickers. 3 stocks that you're like, you know what? If I had an unlimited amount of money, I would buy the crap out of those 3 stocks right now.
Out of this list?
No, just I mean, this is just the heat map, but in general, you can look at your own watch list. And have any prices gotten so stupid? Like, is it that type of a sell-off where things have gotten absolutely ridiculous? Because I don't think it's that type of a sell-off. Yeah, you know what I mean?
No, I mean Meta has been cheap before. It's just cheaper now. It's just not much has changed.
Meta would be on my list because I feel like it just continues to get cheaper and cheaper. It's I think the cheapest Mac 7 now. Nvidia is not on my list yet. I think Nvidia needs to get back to 180 for it to be
180.
Look, it's dirt cheap at 200, but if you've been buying it from 160 to 180 throughout the whole year like I have, then I'm not touching it at 200, bro. It needs to come back down. You know?
They're growing revenue by like 85%. Every quarter that they show off, this company gets cheaper. And then if the company doesn't move, like margins are expanding still. Like their net income margin was like 71%.
Would you buy Nvidia at 200?
If it wasn't 50% of my portfolio, that's definitely on my top 3. I was going to say like Meta,
but that's why he's
Broadcom,
not buying it
Nvidia.
at 200.
It's not 50% of my portfolio, but I bought it. But my point is, it's not absurdly like Chandler. If Nvidia was 140, I don't care if it would 70% of your portfolio, you'd probably be buying more here, right? But it's not that absurd yet.
Yeah, but I don't think anything's like crazy absurd right now. We just went on a insane rally in a lot of these semi and hardware names. We're having some of these names are having 10% pullbacks, 15% pullbacks. It's nice, but it's not like even Nvidia, we've gone from like 235 to 200. It's nice, but not. Go ahead.
Yeah, obviously, Nvidia is cheap. There's no denying that. There's no denying Meta is cheap as well. The question is, at what point does it become back up the truck? And Meta to me kind of feels like that because it hasn't made any move this year. Nvidia doesn't really feel like that yet, although hopefully it bottoms around this range. I don't know if Nebius at 206 is back up the truck for a lot of people, given this thing was $80 a couple months ago, right?
Even though Leopold's purchase price, I think it was like 198. So
is it?
Yeah.
How do you know?
The 13F that was filed, or the SEC filing that was filed.
They don't disclose cost basis on this.
I'm pretty sure it's like 197. Let me go to Will Wisdom.
The most recent one when they had to disclose that it's over 5%. So I think they gave you maybe an average price or something.
Interesting. So if he hasn't sold, that dude is almost break even on his Nebius position, which maybe means he buys more here.
Yeah, we know his purchase price, or sorry, we know the price he paid and the amount of shares. I think it's like 197 something is what it averages out to. And that's his biggest position too. He made that larger than any of his other names.
I did buy Reddit this week.
Ooh,
my man.
See, I think Reddit's cheap, but I feel like dirt cheap. You got to go back to the 150s on Reddit. And it's not. See, that's the thing. A lot of these names, like, they're just not dirt cheap, like they were in March. And I don't say we have to get to March prices, but like AMD 560 to 450, is that the dip, or below 400? Is that more exciting?
And it's also the timing. Like if we're talking after the next earnings report and we got more information and guidance, etc., and it's the same price, then I could say, okay, maybe.
Right.
Maybe now it's worth paying the price because I got the extra info, and maybe guidance is even better. So it makes the valuation even more attractive. But right now, everything has gone up very quickly. We had the earnings season behind us, basically. Now I'm just like, okay, now I'd rather wait for the next report and see what the heck is going on instead of saying, oh, we're down 10%. I've already seen a couple of tweets like, oh, correction. Like, what correction? Well, where is it? I don't see a correction. I still see quantum computing names worth $10 billion plus or whatever. That's not a correction.
Yeah, that's the other hard part about buying the dip right now. It's like, if you think the S&P is actually going to have a real correction, all these names are going to be so much cheaper.
Yeah.
But it's also kind of greedy to imagine we're going to have another 5-7% down from here, or it might be responsible to think it could happen. But if it does, Micron back in the 600s, Broadcom back in the low 300s, like those prices will appear. And it is just a question of who has the patience to wait for them. And is the market even going to be willing to let them get to those levels if we do go down?
Yeah. Yeah. I just think like, dude, I'm looking at the models, and I don't have direct stakes in any of these model providers other than, you know, Google or whatever, but I'm talking about OpenAI and Anthropic. And these things are becoming more useful over time, whether or not it's the frontier models or the lower priced models. This will allow for businesses to get more efficient, not less efficient. And we are taking like massive step changes. Like Opus 4.5 or 4.6 was a massive step change back in December, where vibe coding really came online and people got to start seeing this. And that exploded their ARR. Now I think Fable 5, or this watered down version of Mythos in ChatGPT 5.6, is going to be another step up in multi-step reasoning, in agentic workloads. Businesses are going to find more use cases for this. And I'm not talking about the day one, you know, create a Minecraft clone. I don't think that's the use case. I think this is let's sit down, like, let Meta sit down with this, with their thousands of engineers and unlimited token budgets, and really see what you're going to create over time. Models are continuing to improve. There was a statistic that recently came out from Anthropic that said the length of their or the length of tasks that these models can deal with is doubling. And it used to double every 7 months. Now it's doubling every 4 months.
Wow.
So the rate in which these models are handling more complex tasks is getting faster. And doubling is still doubling, just doubling, like it's just getting higher and higher and higher at a faster pace. If people don't see the trend there, I don't know what to tell you. Like we're staring down a major change, and people, you know, are saying, "Hey, I don't use it for this reason, so I'm not going to invest." Like, okay.
Yeah, no, it is scaling at an unprecedented level, which is why these companies have the valuations that they have. I am going to be curious when they go public how much these headlines and these exponential curves are going to matter to the street. Like, will they actually give Anthropic $1 trillion valuation when it goes public? I mean, because, you know, Meta's at what, 1.3, Anthropic's at basically $1 trillion. It'll probably go up at 1.5. If Meta stays at this price and Anthropic IPOs, Anthropic will be more expensive than Meta. Meta has $100 billion in operating income. Anthropic has 0, which is fine. But at what point does the street be like, okay, as a public company, we're just not going to allocate institutional capital to this thing versus this thing at these levels when this one has all this free cash flow, this one has all this growth? I don't know. It's going to be very interesting to see how that.
Agreed. I'm not saying pour into the model names. I'm just saying, you know, their changes will make big differences for all companies. It'll make efficiencies for Walmart. It'll make it, like, I'm not saying just buy AI names. I'm just like, I wouldn't be bearish in these markets. By the way, is the call? It's 5.
The call is not officially live yet.
Okay.
Once it goes live, we'll switch. Oracle stock, where are we at right now? We are at 186.88. So obviously it's down about 7% and falling. And either this thing maybe, you know, collapses on some bad notes, or takes a rebound here. But we're going to have to see when we get the call. Call is still not officially live yet. Patrick Mahomes just got a $500 million deal.
Patrick Mahomes, the NFL player?
Correct. $504 million till 2033.
From the Kansas Chiefs?
That's correct. Yep.
Hmm.
So, yeah.
Is he a data center?
Speaking of someone who could buy the dip, there you go.
It is
All
pretty.
right.
I forget who said this first, but like sports will be insulated. Like that's one area that like just guaranteed it'll be fine.
Yeah.
Of course,
right.
you need to entertain the masses.
Yeah.
Financial results tables, supplemental financial metrics, and guidance are now available from the Investor Relations website. Also is a slide deck being introduced this quarter, which you'll see momentarily, a GAAP to non-GAAP reconciliation, other supplemental financial information, and list of many customers who purchased Oracle Cloud services or went live on Oracle Cloud recently. These items will be available after today's call. As a reminder, today's discussion will include forward-looking statements, and we will make some important comments around factors relating to our business. These forward-looking statements are also subject to risks and uncertainties that may cause actual results to differ materially from statements being made today. As a result, we caution you against placing undue reliance on these forward-looking statements, and we encourage you to review our most recent reports, including our 10-K and 10-Q and any applicable amendments. And finally, we are not obligating ourselves to revise our results or these forward-looking statements in light of new information or future events. Before taking any questions, we'll begin with a few prepared remarks. And with that, I'll turn the call to Hillary.
Thanks, Ken. Hi, everyone. Great to be here with you today. And as new CFO, I thought I'd start with a few thoughts on why I'm so excited to join Oracle at this time. I've spent my career all around the world at companies that use technology and data to drive transformation, both internally and for customers. And I believe that the most valuable transformational change sits at the juxtaposition of the physical and virtual worlds across business models, from infrastructure to enterprise software. Oracle understands that intersection and is now uniquely positioned for one of the most significant technology transitions we've seen in decades. Very few companies can help customers across the entire technology stack, from the cloud infrastructure that powers AI workloads to the mission-critical applications that run their businesses. Oracle can do both. Plus, this is a company with deep technical expertise, differentiated technology, and a long history of helping customers turn technology innovation into tangible business value. And while I've only been here for 2 months, everything I've seen has reinforced my confidence in the company's strategy, execution, and opportunity ahead. I'm excited to be part of the team and look forward to helping Oracle capitalize on the opportunities in front of us to drive return on investment and shareholder value. And as we pursue these opportunities, we'll remain focused on disciplined capital allocation, maintaining a strong balance sheet, and preserving our investment-grade credit rating. With that, let me turn to our Q4 and fiscal year 26 results. And like Ken said, we've introduced a short presentation to accompany our earnings call, so you can follow along with the numbers and key comments we'll make today. In terms of Q4, it was a record quarter, driven by strength in both our cloud infrastructure and cloud apps business. Revenue was $19.2 billion, up 21% in US dollars. Cloud infrastructure revenue grew 93%, reflecting strong demand for both AI workloads and our database services, and cloud apps was up double-digit at plus 10%. And Michael Clay will give more detail on these businesses in just a moment. Our non-GAAP operating income increased 22% in US dollars to $8.6 billion, driven by our strong revenue progression. Our operating margin increased slightly, with our gross margin declining, driven by impacts from ramping up our data centers and the acceleration in our infrastructure revenue. This was more than offset in the quarter by a reduction in operating costs And for us, that's the lines in our P&L, starting with sales and marketing, due to efficiency actions in our cost structure. Our non-GAAP EPS reached $2.11, an increase of 24% in US dollars for the quarter, partly due to a one-time net gain on investment. Excluding this, our non-GAAP EPS increased by 20%. Turning to the full year, we surpassed revenues of $67 billion for the first time, which translated into strong non-GAAP operating income of $29 billion, up 16% in US dollars for the year. Our non-GAAP EPS was up 27% in US dollars to $7.63, including one-time gains on investment. Excluding these gains, our non-GAAP EPS was $6.83. For the full year, our gross margin stepped down around 5 points, as expected, as we start to see the impacts from the build-out of our infrastructure business and the acceleration in its revenues, primarily offset by lower operating costs as a percentage of revenue, driven by operating efficiencies. All of this translated into strong cash flow from operations of $32 billion, up 54%. We did continue with our program of capital investments tied to unlocking the strong growth opportunities in front of us. Our net cash outlay for capital expenditures for the full year was $48 billion, taking into account prepayments and timing impacts of around $8 billion. You can see the table showing the details of net cash outlay for CapEx in our press release. We think this measure is important to better understand our funding needs. And our remaining performance obligations, or RPO, finished at $638 billion, up 363%. This unprecedented level of RPO provides exceptional visibility into our future revenue growth, all supported by long-term contractual customer commitments, and reflects the strong customer demand we see across both AI infrastructure and cloud services. To give a bit more detail on our RPO, we expect 12% to be recognized in the next 12 months, and another
Is it just me?
That is, I mean, it's my fault, but it's technically Oracle's fault. I can refresh it.
For service and create real competitive advantages. They're able to do it quickly and within their existing budget envelope. Oracle's unique advantage is that we deliver the applications, the data, the infrastructure, the AI tooling, and the industry expertise together. That combination invariably puts us at the center of customer conversations, whether they're existing Oracle customers or not. And our customers have moved past the experiment stage with AI. They are ready to implement enterprise-grade, complete agentic solutions to help run their businesses. Over the past year, we have delivered more than 1,000 AI agents across our application suites. These agentic-based offerings can reason, decide, and execute work across processes. So the quickest, most affordable, and most productive way customers can begin consuming AI is just to continue using Oracle's applications, since every 3 months they get more and more of the AI features built for them and ready to go. This is a major shift in enterprise software, and Oracle is uniquely positioned to lead it. And you can see it in our Q4 results. Oracle Cloud Applications generated revenues of $4.1 billion, which was up 10%, and our SaaS deferred revenue was up 16% in the quarter. Across the company, we took thousands of customers live last quarter, over 300 in Fusion alone. Exelon adopted our utilities platform to manage operations. Wright County Sheriff's Office went live with our public safety suite. Westfield Insurance implemented Fusion ERP, and Piraeus Bank went live with Oracle Banking, just to name a few. All of these customers are upgrading to a better and modern applications platform that also comes with AI built right in.
In Q4, we also continued our electronic health record deployment at the United States Department of Veterans Affairs. In Q4, we added 4 VA medical centers in Michigan, and in early June, added another 4 VA medical centers in Ohio. So Oracle now supports 14 VA medical centers, serving 29,000 clinicians and 500,000 veterans across the United States. And while not part of our Q4 bookings, the United States Government Office of Personnel Management today announced an agency-wide award to Oracle for Fusion HCM. So this is obviously a strong start for us in our FY27 applications business. Now, in addition to discussions around AI within our applications, I'm also having very interesting conversations with our customers around leveraging their own proprietary data sets with AI. Much of this data already sits in an Oracle database or is generated by Oracle applications. For many enterprises, inferencing against decades of rich operations data is where the benefits of AI compound exponentially. Oracle's full stack offerings allow customers to get up and running quickly, leveraging AI together with their private data sets. This is why Claro, a major telecommunications provider in Latin America, chose OCI, field services applications, and our AI data platform to automate customer service for their 30 million subscribers this quarter. UK National Health Services share business services. Olis, the Brazilian retailer, and QXO, the fastest growing building products distributor in the United States, combine AI-ready Oracle infrastructure or database products with Oracle applications to move their businesses forward. Again, just to name a few. Last quarter, we also released a long list of major new AI functionality in the Oracle database. Here are just 2 examples. The Oracle AI Agent Memory is a library that helps developers build agents that can remember, reason, and act with enterprise context. Oracle Deep Data Security adds data access rules at the database level. This protects against both unauthorized access. It limits precisely what data a user and any AI agent acting on their behalf can see or act upon. All of these innovations I've just described and many more are available in our cloud, our partners' clouds, and in our customers' environments. In Q4, our cloud database business revenue grew by 29%, with multi-cloud growing much faster. Multi-cloud revenue was up 404% year over year, and bookings were up 325% year over year. One example of an enterprise using a wide range of Oracle technologies is Vodafone, who turned to us in Q4 to consolidate and modernize their operations. Vodafone selected OCI dedicated region in their data centers, our multi-cloud database offering and a partner cloud, and our applications to reduce costs and run their processes faster, in some cases up to 60% faster. Finally, we are working with our customers to deliver quick ROI within their AI budgets. To do so, we are simplifying how customers consume and pay for agentic capabilities. Our new agentic pricing aligns with customer value. Now, much of our AI innovation in our core applications continues to be included at no extra charge. However, customers can also purchase additional agentic capacity in a simple, predictable way by purchasing bundles of tokens that can be used across our application suites. We're also introducing outcome-based commercial models that align pricing directly to the value derived. For example, interview agents that are priced based on the number of candidates screened, or hospitality upsell agents priced on the percentage of end consumer upsell transactions. In Q4, we started a limited rollout of our token bundles and had 33 customers, like Aon Services Corporation and Liberty Energy, pre-purchase tokens that have access to more advanced reasoning and models. All of this helps our customers control their costs and align their spending with the value being generated. And with that, I will turn it over to Clay.
Thanks, Mike. Okay, you just heard from Mike about our applications and database businesses. Oracle has been in these businesses for decades, and they continue to impress us because of their ability to continually grow aggregate margin dollars through a combination of durable differentiation and increasing market size. I want to share how we see our infrastructure business in that same category and the evidence that enforces that belief. Okay. Differentiation comes in many forms: technological innovation, supply chain execution, operational ability, and more. We created OCI as the most highly secure, highest performance, most flexible, lowest cost infrastructure available anywhere. We deliver that through innovation across all layers, from deploying the smallest and the largest clouds to inventing technologies like Acceleron that provide the highest performance and lowest cost networks. We combine the power of OCI and Fusion applications to implement an incredibly efficient and flexible supply chain. We architect across data center design, power distribution, data hall layout, and networking to deliver the most efficient and the most flexible infrastructure available anywhere. Oracle has a long track record of durable differentiation. This is because we know the real differentiator is the organization, the people, the company itself that can adapt to new requirements, invent solutions, and deliver them to customers rapidly. OCI has been the fastest growing cloud provider for years. And now with AI infrastructure, we've shown to everyone the power of the organization we've built, the technology we've created, and the value we're delivering to customers. OCI is continually releasing new services, hardware, networks, and cloud regions to ensure we are always the best place for our customers' infrastructure workloads. Cloud infrastructure has become a very large market because of the ever-growing demand for server-side computing. AI infrastructure makes the existing cloud infrastructure market look small. Everything we see shows this market size is trillions of dollars per year. Combined with our previously outlined 30 to 40% margin profile, OCI should grow into an extremely large and extremely profitable business. These beliefs are supported by compelling and multiplying amounts of evidence. We signed $67 billion in AI infrastructure contracts this quarter, the majority of which was either bring your own hardware or prepaid. This increases our combination of bring your own hardware or prepaid customer contracts to $75 billion, with those contracts having no degradation in margin compared to our other contracts. Customers are showing that they chose OCI to deliver their infrastructure, even when they are bringing the capital themselves. Design, delivery, and operation of this large-scale infrastructure is extremely demanding. Q4 finalized an impressive FY26, where we delivered more than 1.2 gigawatts to customers. Our pace of delivery continues to accelerate, with our FY27 Q1 delivery approaching 1 gigawatt, nearly the same capacity as we've delivered in the previous 4 quarters combined. There will be many winners in AI, and our strategy is to have them all as customers. We continue to diversify across our largest customers, with 4 customers contracting for more than $8 billion this quarter. Our infrastructure is fundamentally multi-tenant, and we continually allocate capacity between customers. In Q4, 35,000 GPUs from 59 separate customers were up for renewal. 49% of those customers renewed for 92% of those GPUs. That doesn't mean, though, that 8% of those GPUs are idle. Most of those GPUs themselves were subsequently sold to other customers in the same quarter. Our global GPU utilization rate is 97.5%. It's also clear that AI is here to stay. AI is delivering value on multiple fronts, but the most clear and obvious is agentic coding. This is an area where we have a front row seat as both a provider and as a consumer. Agentic coding tools have completely changed how Oracle operates, and we've seen no slowdown in our own demand for such capabilities. The same is true for all the customers and partners we work with. The demand for AI infrastructure in this domain alone is enormous, ignoring the many, many other growth areas. Okay, now, before I end, let's look at a summary of our 5 largest sites and the significant progress we're seeing across all of them. To begin, let's look at Abilene, Texas. Abilene, Texas today has delivered 42% of the total capacity. An additional 35% of capacity will be delivered in the next 90 days, with the remainder delivering in the subsequent quarter. Moving forward to Shackelford, Texas. We contracted this in August of 2025. Customer delivery begins in the first half of the first half of calendar year 27. 115 megawatts of power capacity is already available online, more than 1 month ahead of schedule. If we take a look at Doña Ana County, New Mexico, we contracted this in September of 2025. Customer delivery begins in the first half of calendar year 27 as well. Power design is based on gigawatts of clean, energy-efficient Bloom fuel cells. We look at Saline, Michigan. We contracted this in October of 2025. Customer delivery begins in the second half of 2027. The network core is ahead of schedule and delivered at the end of this calendar year. And then to the final site I want to touch on, Port Washington, Wisconsin. This was contracted in September of 2025 and delivery begins in the second half of calendar year 27. I think you can see from all of these pictures the massive progress that we're making across a very large number of sites. It's an incredible time to be in technology and to have the privilege of doing that at a company like Oracle. It's especially fun to have an inside view of the birth of a new business that can join the likes of our application and database businesses. Hopefully, these beliefs and the data points give you some insight into why we are so excited about OCI and where that's going to take Oracle. And with that, I'm going to hand it back to Hillary.
Thanks, Clay. Before I get to our fiscal year 27 and Q1 guidance, I'd like to share some comments on our funding expectations. We already mentioned throughout the call the compelling opportunities we see at Oracle based on our portfolio positioning, and our strong Q4 results reflect this well. Customer demand and our growing visibility into future revenues is what underpins the long-term financial outlook we shared at our most recent Analyst Day of plus 31% revenue CAGR and plus 28% EPS CAGR through our fiscal year 2030. In order to unlock this unique growth opportunity, we started a program of capital investments. We'll continue those investments in our fiscal year 2027 with an expected net cash outlay for capital expenditures of around $70 billion. This includes customer prepayments and timing impacts expected at around $20 to $25 billion, so our reported CapEx will be higher by this amount. Importantly, these investments are being driven by committed customer demand, reflected in our record RPO, giving us confidence in our long-term outlook as well as strong returns on the capital we're deploying. As Clay already mentioned, this demand is allowing us to garner customer prepayments and bring your own hardware at similar or better margins than the rest of our contracts. To support our capital investments program, we expect to raise around $40 billion in debt and equity in our fiscal year 27, and that includes our already announced $20 billion at-the-market equity issuance. We don't anticipate raising additional debt funding in calendar year 2026. To our fiscal year 2027 guidance, you can start to see the strong translation of our RPO into revenues, with expected growth in our total revenues of plus 34% in constant currency, surpassing the 5-year revenue CAGR included in our long-term outlook. Our fiscal year 2027 gross margins will step down due to timing for the ramp-up of our data center projects into their full revenue contribution, plus impacts from mix. While these investments are creating pressure on the near term to gross margins in our infrastructure business, we expect margin performance in infrastructure to improve rapidly as we reach full contractual revenue levels at our data centers. Operating costs we expect to be slightly negative year over year in dollar terms due to efficiency actions driving improved operating leverage. Net-net, we expect our non-GAAP EPS for the year to be $8.05, up 18% in constant currency, excluding the net one-time investment gains we booked in fiscal year 26 from Ampere and Bloom Energy. I'll finish with guidance for our Q1 2027. In Q1, we'd expect growth in total revenues of between 27 and 29% in US dollars. Of that, we expect growth in cloud revenues of between 58 and 64%. In non-GAAP EPS, we expect between $1.72 and $1.76, up between 17 and 20% in US dollars. And we anticipate revenues and earnings will accelerate in the second half of the year as we bring further megawatts online at our data centers to fulfill customer demand. I look forward to speaking further with all of you over the next few weeks and months leading into our Q1 and at our next Oracle Investor Day scheduled for October 28th in Las Vegas. With that, I'll turn the call back to Ken for the Q&A.
Thank you, Hillary. Lisa, if you'd please pull the audience for any questions they might have.
Absolutely. And ladies and gentlemen, once again, that is *1 if you have a question. We ask that you limit your questions to one. The first question comes from John DiFucci from Guggenheim Securities.
Thank you. So my question is a question that I've dealt with all this quarter. In Clay, that was a ton of information you gave, which is helpful, really helpful. But there's one little nuance here. You spent a little bit more this quarter on CapEx than we expected. And that's sort of the topic a little bit. It adds into it. We all know that component costs have gone up a lot, especially memory. It's grown significantly, right? And even though you said that most 3Q and 4Q contracts are large-scale AI contracts that were prepaid for GPUs, you have a lot of other contracts. This has been an issue for a lot of software companies and large cloud companies. I don't think it's as much of an issue for you, given my understanding of how you construct your contracts. But can you explain that to investors, like when it comes to these very long-term contracts, like between you and the end customer and the suppliers?
Sure. Yeah. Good question, John. Good to talk to you again, as always. Look, I'll answer, I think, that in two parts. In terms of the capital expenditures, at least from what we're seeing in Q4, any increase in CapEx that is not due to component prices from our perspective, that's largely around timing, right? I mean, part of my job is to figure out ways to actually accelerate CapEx. Hillary has a tough life. My job is to try to spend the money a little bit faster so I can get ramp revenue sometimes. So I don't see that as related to component prices. Now, talking about component prices in general, look, I think everyone knows that memory prices have definitely gone up, SSD prices, hard drive prices, et cetera. So one of the things that we do, John, is it's actually quite simple. When we're selling stuff in a time period where we have certainty, whether that be certainty because the capacity is already deployed, or we have certainty because we have locked prices across the spectrum, whether it be space and power costs, energy costs, people costs, component costs. When we know those costs, we will then do fixed price contracts. Times that we don't know those costs because it's out too far in the future, or we have too much supply chain risk, whether that be due to just the way the world works or a lack of things being locked in. We then do not do fixed price contracts with our customers, and we have a mechanism whereby those costs end up being floated. So I don't like it when costs go up. Our customers don't like it when costs go up, and honestly, I don't think our suppliers do. I think they'd love to be able to give us everything we want. But when the costs do go up, we have I think a very robust set of mechanisms that ensure that Oracle is not sitting there with reduced margins.
That is really helpful. It makes a ton of sense. And if I could, just a quick one. Hillary, you kind of alluded to what I'm going to ask, but this is a second question I get a ton of questions on. You have long-term targets out there. You're a new CFO, right? And congrats. It's great to have you on the line. But can you just comment on those long-term targets at all? I know you've only been there a couple of months.
I think, and that was the intention of putting it in the slides. I think that we're reconfirming those long-term targets in the sense of the CAGRs that we put into the slide today. So we feel comfortable with that, and you can see the RPO building to the level that you can start to have a lot of belief, I think, in those long-term targets. Exactly. So full reconfirmation from my side on the long-term targets.
All very clear. Thank you very much. Nice job, you guys.
The next question comes from Brad Zelnick, Deutsche Bank.
Great. Thank you so much for taking the question. And Hillary, welcome to Oracle. Hillary, as you come to Oracle from a capital-intensive business in another industry, how would you suggest that investors evaluate Oracle's progress and returns during this period of heavy investment?
Yeah, so the way I think about it, and as we said in the earnings call, we feel the returns for the infrastructure business, so that CPU and GPU business, are quite strong. Probably from a back of envelope standpoint, the way I think about return from that business model is in return on invested capital. And what we see is return on invested capital in the high 20s at a steady state. So once the revenues have ramped for large projects at the project level. And that doesn't take into account upsides, like who knows if, the GPUs don't need to be replaced over the long term and things like that. Just purely in the steady state, when we're at the steady state of the contracts that we have. And as we're generally able to preserve and improve margins in the case of things like bring your own hardware, the ROIC for those types of structures will be even higher. And again, that back of envelope, I'm just calculating return on invested capital as after-tax operating margin plus depreciation divided by gross investment, so total gross CapEx at the project level. Maybe that gives you a little bit of an idea. And of course, we're happy to talk more about that over the next couple quarters.
That's really helpful, Hillary. Thank you. And congrats to the whole team on the execution this quarter. Nice job to everybody. Thank you.
Up next, we'll take a question from Mark Mordler from Bernstein.
Thank you very much for taking my question, and also congrats on the quarter. And Hillary, welcome, and we're really looking forward to working with you. Clay and Hillary, with so many vendors entering the market to deliver AI data centers, including the NeoClouds, SpaceX, which is now going to build data centers in space, et cetera, where does Oracle see itself in the competitive landscape? And how do you see that increase in capacity impacting your ability to, one, retain customers, renew contracts, two, capture new customers, and three, maintain or improve margins? Thank you.
Yeah, thanks, Mark. Look, I think that first, I think it's very important that we stay focused on customers. So the nice thing is that I think whether you see it from existing RPO or increased contracts that we're getting, yes, there's a lot of things happening in the market, but we have a large, diverse set of customers, both very large and also smaller customers. And what I spend all of my time doing is I wake up every day and I go, how do I make sure those customers are as happy as possible with us? And that's, when I shared the numbers, for example, in the prepared remarks about the extremely high utilization rate, even when things come back for renewal, they're instantly snapped up. Those are all indicators that we have great customer relationships. They're happy with the products and they're very satisfied with the prices that we're charging for them. Look, I think there's going to be a lot of people who enter the space. I think there's clearly, several years in, there's still a massively higher demand than there is supply. And so I think there are going to be more and more people trying to figure out how to meet that demand. But I don't worry about that. I really focus on how do we make sure that we can meet as much of that demand at a reasonable margin profile. And that's what I think you've seen us invent new business models to go out and try to serve. In terms of how does that affect our future renewals, I find that largely what affects future renewals is the several years relationship that we're going to have between now and then. And we're fundamentally in the service business. It's one, if you think that you're just buying something and then you're done with it, it's not the way it works, right? These people are relying on what we do at Oracle to run and maintain these massive clusters every day. And our ability to do that extremely well creates an extremely positive relationship that then ensures that renewals go well. And then in terms of the margin profile, look, I've been at Oracle now for 12 years, the whole time I've been working on OCI. What I can tell you is it's not easy to build an extremely efficient, highly secure, robust cloud. So I think that our customers see and appreciate the value of what we provide, the flexibility that we give them, the comprehensive set of services that we provide. So I think that over time, as the market continues to mature and we deploy more and more of our research and development dollars into making things more efficient, I think there's ways that Oracle gets higher and higher margins, but we actually can offer lower and lower prices to our customers. That's ultimately the job that is on our shoulders and what we've been doing over the past decade. It's why the biggest and most robust customers come our way.
That's really helpful. I do really appreciate it. Thank you.
The next question today is Keith Bachman from Bank of Montreal.
Yes, thank you very much for the question. Mike, I wanted to direct this to you if I could. You mentioned two things as net new. One was moving towards outcome-based commercial pricing models. The other was rolling out some incremental token packages. And I wanted to see if you could flesh out the why. And more specifically on the commercial outcome-based commercial pricing models, how do you think this reduces friction? And what is this related to? What modules? In other words, I assume this is the SaaS portfolio, ERP, HCM. What models might this relate to? And then finally, how do you think this might impact growth? That's it for me. Many thanks.
Sure. Yeah, thanks for the question, Keith. So outcomes-based pricing is not entirely new for us. So this is something we've been doing in our construction business, based upon construction value under management, subcontractor, general contractor, the subcontractor cash flow and payments, upsell deals, as I mentioned in my prepared remarks with hospitality, and even in healthcare, in our new AI-based automated agents, where we're automating doctors' notes, we're automating lab orders, we're able to measure and actually price based on patient throughput, which is what the providers, one of the things providers care about is how many people can we get through a healthcare system, reduce waiting queues, get better service to patients. What is new is that we're now expanding that offering across our entire fleet, as you mentioned, across all of our applications, including our Fusion piece. Now, the sort of difficult thing is if you're not creating the outcome in the first place, that's a tricky thing to price in. But since we've made this full stack investment, and since we're able to very easily take the best of the output from the large language models to our customers, pair that with both our horizontal applications and our industry applications, we have a very easy way to measure outcomes for our customers. And as I mentioned, one of the things we're increasingly hearing from customers is, how much am I going to spend on AI, and how do I get ROI very quickly? So I think we have a very unique advantage. Since we're in the infrastructure business, we have large language model, large LLM vendors training on there. We've got all of our applications business, both horizontal and vertical businesses. We are naturally generating these outcomes for customers, and it really gives us the ability to help them understand their own AI budgets, as well as align that to the value, again, which is really easy to measure. So I think it's a unique offering. It relies on the full stack investment that we made. And as I mentioned, early days, but certainly resonating very well with customers. They appreciate the transparency. They appreciate being able to align outcomes to AI spec. I also mentioned the token bundles. If customers want this, again, a lot of what we're doing in our Fusion applications, our industry applications, we continue to add at no additional charge. If customers want access to advanced reasoning, if they want essentially for more tokens at the models, we have prepackaged bundles to allow them to do that. So we're allowing as much flexibility and as much alignment with the value in our pricing models across our entire application suite as we possibly can. And I expect that will continue to resonate well with customers as it did in the quarter, and as we roll it out across our entire fleet, certainly should be helpful for our growth story as well.
Thanks, Mike.
Your next question is from Raimo Lenschow from Barclays.
Hey, perfect. And welcome to the team as well from me. The question I had was, we talked a lot about like AI and the great momentum you have there, but you still have like the classic Oracle business that we all grew up with, and there's a lot of kind of noise in the market at the moment, especially on the investor side, what's happening to software, etc. Can you kind of address a little bit what you're seeing on the database side? There's OCI at Azure, etc., and overall database momentum, and then on the application side. The growth rate ticked down a little bit, but then you also mentioned on the call some very nice customer wins. Can you see what you see? Can you talk to what you see in the classic business? Thank you.
Yeah, sure. It's Mike. So I'll take a stab here and then ask Clay to jump in as well. So on the applications business, we think double-digit growth on an in-quarter run rate of $4.1 billion is pretty good, and we're certainly happy with our continued double-digit growth. As I mentioned, our deferred position in the quarter grew by 16%. So when our deferred position is growing faster than our in-quarter revenue, it gives us confidence. As far as impact of SaaSpocalypse, I would say maybe a couple quarters ago there were some delayed decision cycles out there as customers saw through that, but really, particularly in the mission critical system space, which is where we play at Oracle, people have quickly moved on to that and realized that enterprise software, particularly when you have AI built into our SaaS solutions, is certainly a very good approach and is necessary to move forward for the modernization and protection of their businesses. So I expect that our applications business will continue to be a healthy contributor to Oracle as as it has been. As far as database, look, I mean, cloud database was 29% in the quarter, with multi-cloud, as I mentioned, growing even, multi-cloud revenue growing at 4x, bookings growing at 3.25x in the quarter. And here's the really good news on database. We're in early innings, very early days on multi-cloud database. We continue to unlock new regions and unlock new partnerships, in some cases with our competitor clouds. We expect that business to continue to be, an outsized growth engine for Oracle going forward. And I'll say that the final piece is that in addition to multi-cloud, the innovation in the database, I mentioned a couple of deep data security and agent memory that we put into the database. Things like vector database search and features that we've been adding into the database are part and parcel to companies' AI strategies. The data strategy matters, data architecture matters, and as the inferencing market starts to take hold, which is again also in early days, a lot of that data sits in the Oracle database across the world, and we expect to see continued investment and growth in our database business as a result. Multi-cloud, all facets of database, Oracle Cloud, multi-cloud, as an underpinning support pillar for all of our applications and all of the bespoke workflows in the world that are running Oracle database. Prognosis is very good.
Perfect. Thank you.
And our last question today comes from Kirk Materne from Evercore ISI.
Yeah, thanks very much for taking the question. I had one, maybe sort of two-parter around the bring your own hardware and prepaid dynamics, maybe for Clay and then for Hillary. I guess, Clay, for you, about 12% of RPO is now related to these type of deals. When you look at the pipeline, where do you think that split could ultimately go? And when you go into these type of deals, especially on the bring your own hardware side, what's the value differentiation that maybe those deals have that, some of the ones that include use, or I guess how does that differ versus the GPU type deals? And then Hillary, just to clarify on the CapEx guide, I think you said 70 billion in CapEx, but that was excluding, I think, 25 billion from some of these prepaid deals. So could you just, I guess, talk about this dynamic as it relates to sort of your CapEx outlook? Thanks.
Yeah, so I'll start and then hand it to Hillary. Look, I would like to tell you that we know all about how things are going to change in the future. I can't say that today. The reality is that what's driving, I think, the mix change is an evolving business model, right? You have a lot of different types of accelerators. You have a lot of different customers. You have a lot of different business arrangements. And so, ultimately, one of the things that Oracle can provide to our customers is that we can go out and put up front capital and then depreciate that over a period of time and help finance the customer's usage of that. But that's not the only thing we provide. And for a lot of customers, it's not even the most important thing to provide. What they contract with us for is the ability to go out and get these data centers constructed, design them properly, secure them, design networks that go inside of them, install a cloud, give the complementary set of services around the specific hardware, because it turns out that a set of these accelerators on their own is not functioning cloud. You need general purpose compute, you need general purpose storage, you need load balancers, you need security functions, you need identity. You need all of that to actually make this stuff usable, and Oracle provides all of that. And then anyone that thinks that these things are easy to operate is very confused. You're not just buying a single rack and putting it into your data hall. These are extremely complex clusters that require constant care and feeding, constant maintenance across the network and the hardware itself. And so when you add all of that together, I think that what you're seeing is that you've got different entrants in the market around accelerators that are helping customers find ways to procure their accelerators. And you've got different customers who have different ways of thinking about that. And so I can't tell you exactly the mixture of when we do bring your own hardware versus when we do prepay versus when we bring the capital. But what I can say is that I think you'll continue to see innovation and evolution in this model, given the rapid changes that are happening across this entire ecosystem. Hillary?
So let me just start. We said on the call a couple of times that we also see the margins in those structures either at or better than the prior contracts that we have. So that's good news in terms of economics. We did introduce this quarter this net cash outlay for capital expenditures, which I think is pretty important. to understand our funding requirements. So indeed, for 2027, fiscal year 2027, we expect around $70 billion in net cash outlay for capital expenditures. That does exclude the 20 to 25 billion in repayments that we will collect, or there's some timing difference is in there, but it's just associated with third-party manufacturers, not vendors, not vendor financing, just third-party manufacturers. So 20 to 25 billion, the sum of those is our reported CapEx. But from a funding standpoint, what's happening here is that these structures are enabling us to have a lower cash CapEx requirement when we look at how we plan our business. And also from an economic standpoint, of course, because we're collecting money up front. So in normal cases, we would put out the CapEx amount, and then later we would collect money from customers. Here we collect money from customers up front, and actually, so that doesn't come out of our funding to pay for the CapEx, or not 100% of it. Therefore, the return on capital is going to be a bit better as well.
Super.
Thank you, Hillary.
That's very helpful. Thank you all.
Thank you, Hillary. So for next quarter, this is a new for everybody. We expect our Q1 fiscal year 27 earnings results will be announced on September 10th. Any changes in the date will be publicly announced. Also, as a reminder, Hillary brought this up earlier, but our Investor Day will be held on October 28th in Las Vegas. We look.
Okay, that was Oracle. Stock went all the way down to 181.50, now at 193, down about 4%. It was down almost 9%. Tanner, we'll start with you. Did you get anything that gave you more clarity?
Honestly, you should start with Neil. I don't follow this name very closely, but I was listening for the amount of demand that they're seeing. They said, we're still like the demand that they're seeing across the industry is still way outstripping their available supply. It's comforting to know that that's still the commentary from, even major names like Oracle. Maybe the market doesn't see that tonight, but Oracle doesn't want to just grow via their own earnings. I think that's too slow to take any market share because the other competitors around them are willing to take larger risks. So, Oracle's willing to take a lot of risks to try to gain market share here. And if you look at the revenue backlog, it looks like they're doing that. It's just a matter of if those customers are actually going to show up and pay. And so far, their cloud revenue is showing that they're accelerating their growth rates and doing quite well. I mean, their cloud revenue is growing faster than AWS, growing faster than Microsoft Azure. They're doing quite well right now. Just we need to see more of this constantly.
I agree. I still have to look back at a couple of details that they spoke about there, but again, nothing really changed from what we heard from them 3 months ago. RPO did increase by quite a lot. I think GPU utilization was, what did they say, close to 98% or so. So I guess it's a 2027 story, because at the start they showed us all of the data centers that they're building out, and I mean these are huge buildings, and these things do take time, and most of them is, I think, 2027. One of them there is Stargate. So I know it's a lazy excuse maybe to say it's a 2027 story, but when you look at the numbers right now, it's not like it's a flat business. It's a business that's growing, but I think the big growth is coming in calendar year 2027 for an Oracle. And in the meantime, we have RPO that's increased by $85 billion. They said 4 customers of over $8 billion each in the AI infrastructure contracts. $75 billion of contracts are prepaid, or customer supplies the GPUs. So it's like the bring your own booze type of thing, but here bring your own GPUs. So I don't know, the market is just not in the mood to reward this, which I get it. It's a lot of future-based results, and okay, fine. I mean, I guess as long as the business goes in the right direction, it should be fine. Like, you don't want to see suddenly a quarter where 10 delays and we have to raise another $40 billion, etc., etc. So that's not happening. So it's not that bad. It's actually a good quarter.
Yeah, it was a great quarter. Outside of the debt raising, the CapEx increase, which all of that isn't actually bearish, it just is interpreted as bearish. I mean, I don't see anything that's bearish. The problem is the U.S. military just began a new round of strikes in Iran, and futures are tanking. And so I think really it's the time Oracle decided to put out this print, which is not their fault, versus the actual numbers themselves. I mean, everything they've said is super bullish for NVIDIA, super bullish for the AI trade, but NVIDIA is below 200 because we can't be at war and have all-time highs. I mean, really for the past 2 months, we were at a ceasefire and we had all-time highs. They're saying it's not a restart of the war, but if you're both going back and forth, throwing bombs at each other, it kind of feels like a war. And so they can gaslight me about SpaceX's valuation. They're not going to gaslight me about if this is a war or not. So,
well, dude, they're still gaslighting us. They're saying, negotiations are fully done. We're just doing, Have you ever seen those guys like, okay, I'm done. I'm going cutting cold turkey. One last bomb strike, and then we're all done. We're gonna wrap up from there. Okay. One last party before we're like, it's ridiculous. Like, this is like the 50th time that they've said that the negotiations are fully done. It's like, they're crying wolf.
2 months wasted is what I'm saying here. Could have done this 2 months ago instead of waiting 2 months to tweet.
That Dolores Umbridge sounding freaking girl on that call was driving me
Pixar
nuts.
woman.
Yeah, like
dude, she sounded like a kindergarten teacher, speaking slow, and everyone could hear her. I was like, "What is going on here, dude?"
I could not help but think of like that this girl. I know you didn't know my Harry Potter reference, but
I knew.
This is who I'm thinking of.
Wait, she's from she's from a movie, right?
Harry Potter.
Oh,
yes.
No. She reminded me of the mom in the Christmas movie.
Don't tell me Home Alone.
No, the other one. The one with the Grinch. Oh, the Grinch. The Grinch who stole Christmas. Like Miss Whoville. Like she looked like the mom of that. But anyway, yeah, it was weird. It was weird. I mean, you didn't really get that much clarity on a lot of things outside of the fact that, as Tanner said, they're super compute constrained. And every GPU they can get online, they get online. Like, this is such a bullish story. It's just, I think the market's kind of exhausted of all of this equity dilution and debt issuance. And then you have this war going on. And we just hit all-time highs. And so, we're kind of consolidating a bit. So if oil spikes up, which, it hasn't really, not even really moving after hours, then that would be what makes it much worse. We had a bad CPI today, but you have too many things coming together for Oracle to go up on a day like this.
Yeah.
Which, unless you have options expiring later this week, it shouldn't really be an issue. And even if they expire later this week, you can always roll them down.
Yeah, no, that's a really good point. Like, I saw a post sort of looking at the combined revenue growth and profitability of the biggest Mag 7 names. And it's like, these are the companies that people are selling off right now. Like, it's okay to take breathers, but it's also important that we understand that this is most likely a breather rather than a sell-off, because these companies are more profitable than ever.
At what point does it become a full-on sell-off to you?
Well, I don't know if I would say that that's stock market related. I think that something has to change in the story for me to realize that it's over.
So we could fall another 5%, but as long as the thesis is intact, it's not.
Yeah,
really,
yeah, 100%. Like, if that Crusoe data center story was real, and people are putting pauses on developments and everything, and there's been a couple companies that have come out and said they've blown through their budgets, but until we actually see something like, Anthropic's ARR really start to slow or potentially even decline, I don't think that we have to worry about the thesis breaking just yet. I know people want to try to front run that, and that's what we're seeing. But, if you remember back in like 2024, there were stories about Microsoft slowing down their build. Mm-hmm. And they were like, hey, you know what? We're going to take a little pause on the build outs of the data centers. And boy, oh boy, if you thought that was the end of the build out, you were far off from where we were. 2024 seems like it hasn't even started yet.
And they were just prioritizing different locations. It's not like their overall. So.
Yeah.
That Crusoe thing was so weird to me. The only way we have wide scale pausing of data center buildouts, there's two ways. Bernie Sanders becomes president, right? You have a real big political movement against it, which theoretically could happen, or there's not enough demand for it. And I think the latter is just very unlikely, given everything we talk about every single day. So as long as
Did
the
you see
demand
the
is
update
there,
to that story?
What is that?
Did you see the update to that story? The Crusoe one?
I did not.
Black Hills Corporation. I've got the Bloomberg story right here. They came out and said, no, actually, the company is continuing and advancing. Crusoe is no longer part of the development. And Crusoe's CEO went live and he said the complete opposite of this. Like he had an interview and said, yeah, the partners, doesn't want to continue. Bro, they don't want to continue with you. They're trucking along. They're going to go find a different partner here. So I don't know if there's what's going on there. But Black Hill's saying, no, everything's fine. 1.8 gigawatts is still very much has not been paused and continues to represent a significant opportunity for the company.
You want to hear a different Bloomberg story?
Yeah.
So Bloomberg interviewed a lady who saved up $6,500 to buy SpaceX stock, and she tried going to the bank to get a loan, 33 years old, to get more money to buy more SpaceX stock.
Public relations manager for what?
I don't know. She's a 33-year-old public relations manager, saved $6,500 to buy SpaceX, wants to buy more, saying there's no such thing as too much when investing in the company. And I think this is an interesting story because I would imagine there's a lot of people like her that do not give a shit about the valuation. They just want to get as much money as they can into the company. And quite frankly, this is who Elon's targeting. This is who he wants. He wants people that don't care about, the short-term nature of the valuation, but just, you want to be part of the story. And I think there'll be enough demand, but
And I was talking with my dad, and he goes, what's happening with SpaceX? And I was like, I don't know. It seems expensive. And we're talking about it. He goes, yeah, but you get Tesla as well. And I'm like, no, that's a rumor of the merger, And he goes, you sure it's not happening? I'm like, Dad, please, give me a little bit of credit here. He's like, I'm pretty sure I read something.
Bro, but even if that does happen, it's not just going to be some magical, they're both together. It's a long process, regulator,
and not just that. Those the company has to merge. The equity on the other side does not just get assumed. You get $2 trillion companies for the price of 1.75. No, they're going to want to get their share of SpaceX, and you're going to want to get your share of Tesla. You're both going to get crazy diluted. The two most expensive Mag 7 mega tech names are going to try to merge together. Your share in those companies does not go up.
Tesla shareholders should have gotten SpaceX shares, but that never happened.
That was an Elon Musk promise.
Amit, would you have Palantir at IPO? Palantir did a DPO, but I didn't. I bought it, I think, a couple months after. But if I did, it was at a $20 billion valuation. Mm-hmm. That's the difference here, right? The difference is, at the end of the day, the valuation that they're offering this to people. And it's just once again, at what point do we say this is just... Because here's the thing. If NVIDIA, after every bullish tailwind you could imagine, is basically giving you less than market weighted returns because it's 8% of the market and it can't go up until the market goes up, and even when the market does go up, it doesn't go up, why is SpaceX, which doesn't have any of the growth, any of the fundamentals, any of the buybacks, anything, going to go up if the market doesn't go up? If the S&P stays flat for the rest of the year, how is SpaceX going to go up, meaningfully from the level that it IPOs at? God forbid the market goes down for the rest of the year. How is SpaceX? It's just if NVIDIA can't do it, I don't know how SpaceX does it. And I don't think anyone's thinking about that versus just the story of SpaceX.
Also, we said before, if Anthropic goes public, $1 trillion might go public, then it will be worth more than Meta. But how much revenue does Anthropic generate And how fast is that growing? Because when you compare that to a SpaceX, like why shouldn't Anthropic be worth more than $1 trillion?
100%, dude. If SpaceX gets to freaking 3 trillion, Anthropic should be 7 trillion or something.
Yeah.
I mean, if we're looking at growth.
I mean, this whole thing just doesn't make any sense.
Yeah, I mean, there's definitely super interesting things, and this is like I would never suggest shorting this company because we don't know what TerraFab is going to like. There's so many interesting projects that Elon works on where he definitely does demand a premium, and the speed at which they do things and address new problems and come up with solutions that no other company has ever thought of deserves a premium. But then I see comments of people trying to like justify the value. Like I saw a comment scroll past and it says like, but you do get XAI and Twitter. It's like, dude, Twitter was a public company before. No one wanted that shit. It was a terrible failing business. And now they make half the amount of revenue. We know the numbers of how much advertising revenue they make. They make nothing, you know? And XAI, it's like, what, you guys want to buy into Grok? Over, like, that's the thing you want to pay a premium on versus Anthropic?
I really spent the weekend trying to look at SpaceX from a lot of different angles to see if I was missing anything, and I don't think I'm missing anything. I think hype might take it up, but there's not
Eric in chat, from my chat, I feel ashamed. He says, I smell political bias.
Oh,
I would love.
Are you an idiot?
I would love to own it. I would love to own it, but
I've got a fundamental bias.
No, this has nothing to do with politics. I'm an Elon stan. I don't agree with him on everything, but I agree with him on a majority of things. And I still can't stomach the valuation on this thing, dude. It's hard-earned money, putting it into something that you just hope will go up in the greatest AI build-out we've ever seen with companies that are trading below 20 times earnings. And we're going to pay what for SpaceX?
Yeah, I've called Elon like one of the best entrepreneurs of all times multiple times. This is not a political bias at all. I'm just, you know, I just, there are other great companies. If it was Cash or SpaceX, there's a high likelihood that I would buy SpaceX. Like I love a generating business, but if it's SpaceX versus other very exciting businesses, like the real TAM in their S1, the high majority of what SpaceX is looking to do is in artificial intelligence. It's actually less in space and more in artificial intelligence.
Yeah, you mean with the data centers, right?
Not just data, like their hope for Grok in their total addressable market, what they want to get into with Grok, with TerraFab and all these things. There are businesses doing this today. Like why do we not see this type of premium for NVIDIA? Why don't we see this type of premium for Google or Microsoft?
Data centers in space, my friend.
Yeah, and
They've got the rockets.
I think the reason we're spending so much time talking about this is because part of the reason we've had this essentially 3 red day and 4 session sell-off. I mean, at least what I keep hearing people say is SpaceX IPO. People are raising money. And so that's why we're analyzing it so deeply. And if it really is that people are raising money, by the way, futures, S&P getting hit 1/3% after hours. If it really is based on, liquidity from SpaceX, then, I mean, if we keep falling, that IPO, it can only sustain its IPO price for so long before that falls down as well. Like the lockup period's not going to save it, you know?
Cerebras didn't even survive a week, I think, in the green, right?
Yeah, no, I didn't. 380 to 200, had a couple of upgrades on Monday. That's why it went up. But yeah, I mean, if you're a sell side analyst, what price target are you going to put on SpaceX? It goes IPO at $2 trillion. What, you're going to put a $300 price target on to $400? Like,
yeah. Dude, if you guys are getting excited about the Anthropic deal and the Google deal, I highly suggest you look at the businesses like CoreWeave and Nebius and Google Cloud and all of those companies. Google Cloud's doing billions and billions of dollars a month in their Google Cloud side. You know, where's their premium? If you think that they're paying 3x the market rate because of any sort of performance gap from SpaceX, I highly suggest that you ChatGPT that. The reason why they're paying a performance gap right now, a market rate difference, is because there's no, like, compute is so constrained that there are no what do you call it? Like data centers collecting dust. There's none that are not being fully utilized. So to be able to just get access to hundreds of thousands of GPUs tomorrow, like that. Just turn on Anthropic can use them right away. That is what they're paying a premium for. Plus, the contracts are able to be canceled in 90 days. Those don't exist for other, those contracts are not being created at Google Cloud and at CoreWeave and all of these other ones that are bringing in way more revenue than SpaceX and have less the premium.
Yeah. Also, people that want to ignore valuation, I mean, like, be my guest, but at some point, you have a tipping point. If SpaceX was going public at $5 trillion, I mean, if you want to ignore that valuation, then okay. But there is a level that people are willing to pay or not willing to pay for the multiple earnings. And you could believe how great of a company, how amazing of a mission that Elon's promoting here. But at the end of the day, it's a business. Like, we're investing in a company. You want to get a return. Those VCs that invested years ago, they can't wait to dump their shares because they are sitting on a 20, 30, 50x. And they did the hard thing, which was invest when no one wanted to, back when it was a private company. But now that it's going public, you have to paint a different story. You have to paint a valuation that makes sense to the public market investors. And valuations can go up and down for irrational reasons. We're seeing that today with the mega cap companies. The idea that SpaceX gets to avoid mega cap drawdowns because it's SpaceX, to me, it's laughable right now. Because if Meta can barely hold on to a $1.4 trillion market cap, SpaceX is going to hold on to a $3-4 trillion market cap. And if it does have a drawdown, what does that mean for the market then?
I think we're all on the same page. I think, like, by the way, I'm not even saying that. I think that the stock will go up on IPO. But with the amount of investors who have shares already that are talking about selling out going into IPO, Brad Gerstner, there was another one very recently. Not Bill Gurley, but it's another one of these guys. And I would just be careful about the lockup periods. I think it's a rolling lockout. So insiders, like employees and stuff, will be able to sell their shares the earliest, and then it goes down to investors and all these things. Do you guys remember how that goes?
Yeah, basically the stock has to pump a certain percentage so if it goes up like 20, 30%, a certain tier of VCs get unlocked their ability to dump shares. So it's 4x oversubscribed. So let's say it goes from 130 to 180 at the open. There's going to be a lot of people that get the ability to just dump, which might normalize it back down to like the 150s. And then, it becomes a question of, is there demand or not?
It's true. Meta can't catch rockets out of midair.
But they can make money.
Yeah. There are some pretty crazy companies doing some pretty wild things that don't have amazing valuations.
Yeah,
ASML
I think
being one of them.
I think the other reason people are obsessed with this IPO is because we have seen in the past very large IPOs have marked the top. It's happened so many times, and so that's why I think people are hyper focusing on this IPO. And if this, now that we've got this ugly price action the past week, it's almost like, okay, is it leading up to this, or is this a fluke and SpaceX will be fine and the market will be able to relax? And like what is the next catalyst that takes the market higher? You could say end of the war, but at this point, every time Trump says we're ending the war without officially ending the war, I don't know if the market's going to care. You could say oil coming down, but that requires the war to be over. You could say inflation cooling down, but that requires the war to be over. You could say earnings, but that's about a month away. And quite frankly, I don't know if Google and Amazon are going to put up as many of the numbers that they put up last quarter, because last quarter they got the benefit of Anthropic and SpaceX getting an increase in their private rounds, which vastly increased their EPS estimates almost by 30%, which is why they beat the street estimates by such a wide number.
Yeah, but our cloud businesses increased significantly as well.
Sure. But they don't have, 80% beats on EPS top line without. So, I mean, they'll have good numbers, but and then if they announce equity or debt again with all the hyper, I'm wondering what is that core catalyst over the summer that just keeps the market at least afloat. And maybe it's NVIDIA again, but even Jensen can't save Qualcomm or Marvell,
He's doing his best.
He's doing his best, and it's I don't know. We're in a tricky situation, tricky spot. I'll be happy to get the SpaceX IPO over with, get that through the system, have that be digested. and then hopefully this war comes to an end, and maybe that's the catalyst to get us into earnings. But if we're throwing bombs at each other tonight, it's not the best thing you want to see.
Yeah.
I think we all understand why SpaceX gets so much attention. I mean, it's the largest IPO ever. It's SpaceX, it's Elon, it's AI, whatever. So it makes sense. The valuation doesn't, but okay, fine. We'll deal with that another day. But I understand why there is so much focus on that. Plus, it's been how many years since we actually had a very, very big IPO, a good, great company going public? Like Stripe, we've been waiting for God knows how long, and I don't even know if they're going public anytime soon. Databricks are already raising, I don't know, round Z soon enough. So this year it's SpaceX, Anthropic, and then OpenAI. We'll see. Perplexity CEO already said that maybe they'll go public in 2028.
Yeah.
So.
Yeah, well, they're much. I think last time I saw their ARR was something like 450 million.
Yeah, no, they're tiny compared to all of the others.
Comparatively,
yeah. Which, I was almost certain that maybe Apple would buy them out, but whatever.
Yeah, I mean, it's going to be exciting to see the IPO. I think just everyone is a little worried about what it means for the markets. It is only 75 billion. I say only with some hesitation, but 70 billion shouldn't disrupt the entire equity markets. But it's this oversubscribed level where if everyone's chasing it, then it will disrupt Meta, which someone might be like, well, Meta's a loser. Let me just sell it and go buy SpaceX. And that's where you get, a lot more.
Yeah, but at the same time, you'll probably also have people that will just unload their bags as soon as possible.
That's true.
And go buy something better.
By the way, I'm super happy that SpaceX is going public. I don't like whenever all of these companies are private. I want these mega cap names, the important American names, to be public. I want access to OpenAI and Anthropic and be able to see those KPIs. It's going to be really nice whenever Anthropic shows off some data in guidance and these sort of things, because I think it will also support the Oracle narrative and the Nebiuses of the world and all of these ones. Like, everyone's talking about the demand, but the demand layer are private businesses that we don't get a lot of access to. So I'm happy that SpaceX is going public. I'm happy that OpenAI and Anthropic, and I'll see which ones I, might fancy, but I probably won't touch any of the three whenever they first come out.
Well, that's one thing. I'm happy. Go ahead, Neil.
No, I agree. I agree with Tanner. I think something we've said for a while. The fact that these Anthropic and OpenAI going public will give us so much more data on this whole AI story. They hopefully give us a lot of KPIs, maybe a mix enterprises, non-enterprises, consumer, like all of these things. And we can then see, okay, this is the AI story for real, because they are the biggest players out there. They can tell us on the enterprise side, on the pure consumer side, what's going on, usage, pricing, how many subscribers in that category, how many subscribers in that. I don't know what details they'll give us, but at least we're going to finally get to see inside those two big players, which without those two big players, this whole AI story doesn't exist, if we're being honest. Like, without you remove OpenAI and Anthropic, everything goes down by 50+%.
Gemini's doing okay.
Yeah, but that's one player. A big player.
All right. Well, we will get SpaceX on Friday. Oracle, again, pretty good numbers, just not the right day to have their earnings, and down 7% after hours, increasing of CapEx, increasing of debt and equity issuance. Street didn't love that. Core numbers were pretty good regardless. And then obviously the reason futures are down right now is because of these U.S. attacks on Iran. I guess we'll get an update on that in the morning, but until then, we're probably going to see a little bit of more volatility here.
And let's not forget that year to date, most of us are still doing quite well, I would say.
Yeah, I mean, obviously, look, if you're levered up in semis, then you're still doing. I mean, look, Micron, it's 875. This thing was 340 in March. So it's hard to have sympathy for someone who's in Micron and is like upset. Like, yeah, on paper, But if you bought it at 500, 600, freaking 400, even if that's 700, you're up a lot. The question is, do those gains to get taken out too? Because if you see a Micron get down to the 600s, 500s, then it's like even the people that were leveraged, that were up a lot. Same thing with Nebius. You got a lot of people full port to that, went crazy. 290 to 204 in a week is kind of wild, but it's also part of the territory that comes with being all in a levered up name. If that goes down to like 150, that erases a lot of gains. So I think those are the gains that people are trying to protect now, even after this initial 5% drawdown.
Yeah, I think many of the infrastructure names are going to continue to do well, including Micron. I think they'll do fine, but I did trim a little bit recently.
Yeah, Marvell here.
In 2 weeks.
Sorry, Neil?
Oh, yeah, we do have earnings in 2 weeks.
Micron earnings in 2 weeks.
Yeah, June
everyone's
24th.
assuming that's going to be an amazing earnings, right? There's nothing to be scared of on that.
No, I think it's on guidance now. Is what people are, looking forward to. But yeah,
did they raise it already, or like give us comments that they're already going to exceed it?
No, not really. I mean, obviously, Micron CEO did state that they're continuing to like demand is outstripping supply, but that's been sort of the commentary that he's been saying at every conference. Not actual updates or anything, I don't think. But we're expecting like 81% gross margin. Like these margins now, we're headed into territories where like they're way beyond NVIDIA. It's going to be pretty crazy now. I think the quarters going forward, at least until new production comes online at like late 2027. I think the roadway is pretty clear for them.
Yeah, they're going to be able to keep those margins at least for the next year, you would imagine, if not more. All right. I think that is it. Thank you, everybody, for joining. We'll be
glad you're back, brother.
Yeah, I feel better. I feel a lot better. So obviously,
it's a shame that you gave Alex Karp COVID, and I'm sure you sent him a letter to apologize, but
I feel like I got it on the plane. I don't know where I got it from, but Karp looked fine today in the interview. So, by the way, Dario just did a 50-minute interview with Bloomberg. So I'm sure there's a lot of clips there. I'll show this one 30 seconds real quick. This is why he said he started Anthropic.
OpenAI has become Silicon Valley lore. What did you disagree on?
Look, I'm going to say it. I'm going to say it very simply. There are many valid disagreements to be had on safety. We certainly had some of those disagreements with them, but people that alone is not sufficient to leave. When you feel that you can't trust someone, when you feel that their values are not what they say they are, when you feel that they're not honest, that makes it very hard to continue to work with a company, to continue to trust.
OpenAI has become Silicon Valley lore.
Weird clip, but those Claude diet plans are, he's looking great.
I mean, bro, he's basically saying Sam Altman, you cannot trust him in the age of AI. And he's directly saying that. And not only did he say that, he built a company that's worth more, that's growing faster than the
and
guy
he's buying compute from Elon, who was also not Sam's biggest fan.
Mm-hmm. Enemy of my enemy is my friend.
Exactamundo.
Could you imagine having to listen to Dario on earnings calls and Sam Altman? Like in a year, we're going to have to do that.
I can't wait.
It's going to be quite incredible.
Yeah, they're going to be amazing.
All right, folks. Thank you all for being here. We'll be back tomorrow. And we'll see if this red ends up continuing tomorrow, and we'll keep going from there. All right. Thank you, everybody.
Thanks, guys.
Tomorrow.
Knicks in 5.
Knicks in 5, baby. We got to get this win tonight.